implication that officials themselves are recognizing weakness that private sector and analysts have been talking about for months?
I think it does. It has to underscore, Lisa, that more government support will be coming. Now, interestingly today, the central bank opted against putting extra liquidity into the financial system because they're saying there's enough liquidity there, and there is a view that China doesn't need lower interest rates. That's not the tonic to solve what its problems are. So what's probably going to come will be more government spending, especially on infrastructure projects, and most likely maybe we'll see a lot of green energy and alternative energy projects getting off the ground as well. We're already seeing stories of local governments ramping up their borrowing, spending being accelerated, and clearly that's where the target is. So it'll be a mix of extra spending, tax breaks for small and medium-sized companies, mostly on the fiscal side, with the central bank, I think, playing a support role, but more support will be coming, no doubt.
To me, and the biggest shock in this story is something Lisa was pointing out earlier. It's just the transparency. I can't believe that they're telling us the actual figures, or what looks like at least a huge miss from their forecast. Why?
Well, there are those who say, Matt, that these figures in themselves are already maybe stretching things a bit too far. They already look like they're a little bit too optimistic. But ultimately, you know, nobody can deny the trend of direction for China's economy in the first half of the year. It wasn't just Shanghai that was locked down. There were dozens of other cities that were locked down. There were restrictions all around the country. It impacted industrial production. It impacted ports. It impacted logistics. And above all, it impacted consumers. And then don't forget the real estate side. The real estate side of things, by the way, the numbers that came out for that today were also quite negative, showing another slide in prices and property investment. That makes up about 20% of the economy. So, as I say, there's always scrutiny and skepticism of China's data, but the net numbers today being, you know, broadly speaking, negative. I mean, I don't think anybody could have really covered that up.
Right, and thanks for the coverage through the Friday evening in Hong Kong and occurring on China. Claudia Sahm has been listening on the foreign moment of Jerome Powell, central banker to the world. She's founder of Sahm Consulting, and most importantly, Claudia Sahm of the Sahm Rule. What an oddity of recession gloom into a fully employed America. Let's get this phrase. It was never in the Michigan textbooks. Can you have a recession in a fully employed economy?
At this point, we can have anything. I mean, nothing would surprise me. It is absolutely unusual to have a recession, and like to see activity, to see GDP contracting for two quarters straight, and at the same time have low unemployment and massive job gains. So we might have what I've heard called a job-full recession.
Yeah.
This is not usual.
You grew up in the crucible, academically grew up in the crucible of inflation study. Michigan is the franchise for studying folks, slicing and dicing. Should our bankers be looking at top-line inflation, or the trimmed inflation, or the core inflation, or the Sahm inflation?
Well, so monetary policymakers ought to be looking at every piece of inflation, both the top line, stripping out food and energy, and also the components. Like, we really need to understand what's driving this to understand where it's going. Now, one thing that I have heard from Jerome Powell that is disconcerting is the idea that top line, including these massive energy swings, will help guide their policy. That's problematic because we know food and energy whipsaw around, and frankly, the Fed, those are supply problems. They can't do anything about that. So that is hard to hear, but it is true. We've had big energy increases, and what they're concerned about is that consumers look at that and they start expecting more inflation, they change their behavior, and they cause more inflation. And that'd be bad.
Well, and Claudia, this is the reason why the Fed is between a rock and a hard place. They don't want to cause recession, but they also don't want to allow those inflation expectations to become entrenched. You have basically argued that the Fed should do what it needs to do to take down inflation. Other supply side issues are not their issue, though. It really is Congress and what happens in Washington. And as a result, the Fed shouldn't go too far. At this point, given the lack of action in Congress, what is too far? How far should the Fed eventually go, just expecting that we're not going to get anything in terms of legislation in a split Congress?
Yeah, well, we learned last night that Senator Joe Manchin is walking away from any kind of energy legislation. And that means the Fed is on its own. The administration has floated nothing that will get gas prices down. So now it's up to the Fed. That inflation will be transitory, one way or the other. The Fed will guarantee that. That's not what we're going to want. The Fed will try their hardest to avoid a recession, but what they are doing right now, the full effect of it comes next year. And nobody knows what's coming next year. We got to have some things in the world go our way. And that has not been the case for 2.5 years. So it's not a pretty picture. And frankly, as Congress walks away, it's getting worse.
Claudia, the timing seems really bad here because the Fed is going all out, guns a-blazing. We're talking about a full percentage point increase right at a time when it looks like inflation really has peaked. I mean, if you look at the Bloomberg commodity indexes on the ags, on the metals, on the oils, they're all coming down markedly. Do you think we're going to see inflation? Where do you think we're going to see inflation at the end of the year? And is the Fed still going to be headed up towards 4%?
This was part of the reason that the CPI print this week was so crushing. Like, the Fed is not going to stop until they see inflation, published inflation from the Bureau of Labor Statistics, coming down in a meaningful way, right? We've been head faked by supply chains getting better, and then Putin shows up, and then they get worse again, or China shuts down and they get worse again. So the Fed needs to see it, and we haven't seen it. Right,
Claudia, into the weekend, what's your so what to the 5 or 6 deciles of America flat on their back with massive negative real wage growth? I mean, how do we deal with that? I've never seen an integrand like that, the area below the zero line.
Yeah, well, we got to get inflation down. Right, the labor market is strong. People they're getting jobs, they're getting paychecks. We've seen wage raises a little bit less recently. You got to get inflation down. You got to get the purchasing power. Right now, households a lot of them have some money on the side, right, from the relief packages and the labor market that's been strong. Yeah. So that is helping with spending, but that can only go on so long. And income is the best predictor of spending. Spending is the biggest part of activity, of GDP. That's,
Okay, Claudia, thank you so much for the Friday brief. Claudia Sahm getting us here into the weekend, her acclaimed Sahm rule as well. Please stay with us. Future is a little green, up 8. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Senator Joe Manchin has delivered a huge blow to President Biden's ambitious economic agenda. Manchin, a Democrat, told party leaders he would not support new spending on climate measures or tax increases. Manchin says he will back proposals on healthcare and drug prices. The European Union is falling behind on its high-profile promises to deliver a substantial aid package to Ukraine. Almost 2 months ago, EC President Ursula von der Leyen proposed spending $9 billion in loans, but only a fraction of that has been agreed on so far. The EU is facing severe economic pain from inflation and a possible cutoff of Russian gas. In Italy, Prime Minister Mario Draghi has less than a week to forge some difficult compromises with the populists in his government. Draghi's decision to offer his resignation plunged the country into a paralyzing political crisis. He said he could no longer trust the parties that backed his national unity government. A confidence vote may be held next week. Global News 24 hours a day, on air and on Bloomberg Quick Tape, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ritika Gupta. This is Bloomberg. With the First Word News, I'm Ri
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Breaking news right now on American banking, and this is the bank people talk less of. We're going to do a clinic right now on a troubled Wells Fargo. They have released earnings with a greater shock than what we saw from JP Morgan yesterday, and a much greater shock than wealth manager, accumulator of assets, Fortress Gorman, over at Morgan Stanley. I heard Matt Miller, Sonali Basak, when these headlines came out, simply say, wow, what is the level of miss? Unfair question, but let's go there right now.
No,
what's the level of miss?
It is a significant miss because net interest income is below $1 billion. The reason this is such a problem for Wells Fargo is interest rates are rising. They have a double-edged sword here because not only is net interest income under pressure, the provisions for credit losses are also higher than expected, and they expect credit losses to keep increasing from these levels.
On October of 2016, Mr. Stumpf was shown the door. From where I sit, this is the least covered of the major banks. It's a mystery. They're in San Francisco. Mr. Scharf does the New York commute as well. But here's the reality. This is the great shrinking bank. I've got JP Morgan over 4 years, 115 gazillion out to 128 gazillion. That's diamond-like growth. At the same time, Wells Fargo is shrinking from 86 to 73. In Scharf's shrinkage plan, how does this lousy report fit in?
Well, think about it this way. They're still under that asset cap, but even beyond that, you have Charlie Scharf, who is a Jamie Dimon protege. And so for him to shrink this bank to greatness is a different type of strategy in an era where their costs are still exorbitant, higher than Wall Street expects, Tom. And that is going to be costly for him to keep shrinking.
And Lisa, what's great about this with Thomas Schode coming up and all of Middlebury, it's like Sonali there encapsulating my hockey career of shrinking myself to greatness. I mean, you can't, Lisa, that's not a business plan. I'm sorry.
Well, it becomes a very difficult one in a terrain where there both are difficult growth opportunities and the existing business is challenged. Sonali, how much are these weak results a story of Wells Fargo, and how much are they a macroeconomic concern concern about what's ahead?
We knew that Wells Fargo would be more exposed to the macro story because they're also the biggest home lender of all of the big banks. Jamie Dimon yesterday was saying that more banks should probably get out of the business in a bigger way. So when they're that exposed not just to mortgages, but also the consumer picture, where provisions are starting to increase further and credit losses are starting to tick higher, Wells is exposed.
This headline just coming out, and this is where we're really getting into the shocks of this rate volatility. $107 million write-down due to market spread widening. Translate.
So this is what we were talking about yesterday, being exposed to these wild price swings in the market. You were talking about value. You made fun of me, Tom, when I said value at risk was going to be a problem here. You're not.
That's a VAR line.
Yes. And
yes, like the old days. Somebody lost money.
And this is not even a very big investment bank compared to the others. And so remember, you're seeing consumer issues and you're starting to see cracks in the corporate and buy-side clients.
Dive into it, and we'll do Citigroup here with Shonali Bassick here later in the morning. Right now, this is a great joy. Thomas Michaud is CEO of Keefe, Bruyette & Woods, KBW. It's a Stifel company, but far more, he is our great voice on the state of American banking. He's not a security analyst. He's actually out there trying to do business. Thomas showed where is the American banking industry, and for that matter, for Wells Fargo, in 36 months. I think we've got to pause there. I don't know, Lisa, I thought my hearing went there.
I'm sorry.
Oh, there he is.
There he is,
Yes,
Thomas showed. Continue, Tom.
Yes, sure. So Wells Fargo, I think, is a unique situation unto itself because of the transition there. And I've been listening to the results just as they've just been coming out, and I haven't had a chance to dig into them. However, I think it depends who you are, Tom, in my opinion, what type of bank you are and what your business mix is. Because the big money center banks, essentially parts of their business are already in recession. And recession is the central point to everything in the banking industry, because it's going to drive what happens to revenues and then what happens to credit. So the investment banks right now are showing declining revenues. Revenues were down 11% for Morgan Stanley. We think any bank with a big investment banking business is going to have a tough run on revenues. At the same time, don't forget what the core regional banks are doing. We've had 2 regional banks report so far. First Republic's revenues were up 22% year over year, while Morgan Stanley's were down 11%. Washington Federal, which reported yesterday, was up 17%, while JP Morgan's revenues were flat. And so I think it depends what your business mix is. And then we should also have a conversation about credit.
All right. So, Tom, before we get there, what's the leading indicator here? The Wall Street or the Main Street?
I personally think the Main Street, because there's a smaller number of investment banks for the industry. The big investment banks, the write-downs that you mentioned earlier, 100%, that's a real issue, which is credit spreads have widened out, and as credit spread, and I think that's been already part of the story of this quarter, which is the marks on a lot of these assets. These are not the assets that regional banks own. These are the assets that the big banks own. So I think their dilemma and their challenges are different, and it's also going to be quite stark because last year was such an incredible year. So the comparisons are dramatic. Don't forget that JP Morgan had a difficult quarter and earned 16 on equity. Morgan Stanley had a difficult quarter and earned 15 on equity. So I think you have to remember the underlying basis of the companies is still pretty good.
Sure, Tom, we're not looking at a meltdown in the financial sector. There is a question, though, as Larry McDonald said, at what point do markets overtake the economy? Do they overtake the narrative in the broader world? How much are we looking at a difficulty of companies raising money? And I speak to you as someone who has a bird's eye view into investment banking activity through KBW.
I think the world has changed, and I think every day that goes by, it's changing more. I think my own personal opinion about the inevitability of a recession continues to grow, and there are actually pockets of business that feel like they're already there. If you're in the equity capital markets have essentially ceased. These businesses are down. Ceased operations. They're down 70, 80%. So if that already feels like a recession. if you're in the mortgage origination business, that is going to feel like a recession. We're looking for originations to be down 41%. So I think that this is going to be somewhat of a rolling experience. The question is really, is it a crisis? I think it's inevitable that we're going to have a technical recession. The question is it a mild recession or a crisis? As of now, my instincts are not a crisis, but I think it's inevitable that this economy is slowing, and I'm watching forecasts and I'm watching real GDP already send these signals.
I wonder how the housing market plays into that, Tom, especially because we're talking about Wells Fargo, but also because I've seen the terms mark to market used in bank earnings reports the last couple of days, Morgan Stanley and JP Morgan. Fortunately, consumers don't have to do that, but the consumer really stretched to get the most unaffordable houses that they could over the last few quarters. And if we go into a recession, is that a problem for these banks?
I think the underwriting has been extraordinarily sound. I mean, first of all, when non-performers go up, which they will, the surprise shouldn't be that they've gone up. The surprise should be that they were zero for so long. It's remarkable how this is the most pristine I've seen the ratios in my career. So it's inevitable that it's going to go up. But where's the real big risk? I'll say two quick points. The shadow banking industry exploded in size during zero interest rate policy. So I think it's going to be very, very keen to watch what happens in the shadow banking industry. There's a lot of credit. It's 4 times the size of the banking industry, we think. Okay, that's number one. Number two is the majority of Dodd-Frank was really good. And so these banks have more capital, more liquidity. They may have higher non-performers, but I think they're going to be able to churn through it, the average bank.
Tom Michaud, Jamie on Park Avenue just emailed in and said, can Michaud talk about a real bank? So let's do that right now, Tom Michaud. The Keefe Bruyette Honor Roll in honor of Dave Barry are the banks out there that are getting it done. And one of them is First National Bank of Long Island. What can James Dimon, what can Brian Moynihan, what can Mr. Scharf, what can they learn from the operation that you've awarded of the First National Bank of Long Island? Well,
Companies like that bank, keep it very, very simple. And they tend to take a lot of collateral, and they don't require a lot of market activity to generate revenue. They're very spread based. Now they have challenges because technology is impacting their business. They need to afford it. But I think the key part about that is we just went through a very long period of time of zero interest rates. Spread lending was not built to really excel when interest rates were zero. As long as we don't get into a crisis, we get a higher rate environment, it's actually going to be okay for a typical regional bank.
I got 30 seconds. How do they survive digital banking? How does every other bank out there, the heritage of KBW, how do they survive my mobile cell phone and my Chase account?
They better get it. They better get on the trend because customer usage is here. COVID accelerated in 5 months during COVID. We did about 4 years of adoption. They better get on board or they will become dinosaurs, and we're seeing them working hard to do it. But there probably will be more consolidation for that reason.
Thanks for the brief. Been too long. Tom Michaud of KBW there with Wells Fargo reporting. Lisa, you know, each of these banks is different, and I have been remiss at this. I've underreported Wells Fargo for years, and now with mortgage rates moving from 3.22, I think it is on a moving average basis, out to near 6%. I'm sorry, Lisa, that's a big deal.
Well, we're looking at a bank that is much more exposed to the consumer, and it is saying the consumer, while still maybe in a good spot, is really losing momentum, and that is the story.
We will have to see. Matt Miller in for John Farrow with Lisa Abramowitz, the president, on his way to Jeddah here in about an hour and a half with Anne-Marie Horton in Jeddah. Stay with us. This is Bloomberg Futures Up 10.
here that has said they're going to do whatever they need to do for inflation.
Right now, the market is giving the Fed basically a green light to go by 100 basis points at the July meetings.
What I'm concerned about is the Fed focusing so much on the headline inflation. They're losing track of an economy which is losing momentum.
When risk assets are moving this fast, the risk assets take over economic data.
The market's starting to price in a much higher probability of a recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, a very eventful Friday. The president traveling in the Middle East, a most historic moment here in 90 minutes. Also a most historic moment, Matthew Miller in for John Farrow, and we welcome him this morning. We've been talking Hummers in the new EV Hummer that I guess Mr. Farrow is looking at. Lisa, the news flow is extraordinary. Let me cut to the chase. Pick it, Lisa. What is your story on this Friday?
On this Friday, it's going to be retail sales in the University of Michigan. Also, what the Fed officials have to say. The bank earnings are interesting, but Wells Fargo is not JP Morgan. It is not the clear-cut bellwether, at least as perceived by the market, as others are. And right now, the market is shrugging off what could be viewed as a fairly big miss, particularly when it comes to net interest income.
Everything she said, folks, is accurate, particularly retail sales at 8:30, but far more interesting to global Wall Street is what's occurred this week is curve inversion, 19 basis points. And Lisa, I've been out front on this, and maybe I'm wrong, but I'm maybe overemphasizing the emerging market decay we observe.
It is another symptom of the dollar strength. It is another knock-on effect that is going to cause some serious issues, and we're seeing that with our own Damian Sassower pointing out that in the credit sphere of sovereign debt in these emerging markets, you've seen 5 years of profit wiped out in just a couple months. And that is what we're seeing. How much and how far can this dollar go as the haven bet at a time when there are so many nations feeling the other side and a flip side of pain?
You know, it's interesting to see this here, folks. I'm going to fold the data check in here with dollar Canada out to 131-ish, even with a magnitude of 100 basis point shock, and I mean shock this week, without question the biggest shock of the week. But Matt Miller, to me, the biggest shock of the week, which folds into the German nat gas debate in this autumn, is the heat wave in Europe. They are talking of modeling above 100 degrees Fahrenheit in London this weekend. This goes up to Leeds and over to Shrewsbury as well. Matt Miller, the heat wave across Europe, you've lived it. How's it different than in America?
Well, I haven't been living in America through a summer for 6 years, so I'm not sure if we're going to hit the hundreds here. I'm sure in New York City we will. That's a typical temperature for Berlin in August. And the interesting thing to me this week has been the euro going down through parity. That's so tightly connected to the gas issues. You've spoken on this program.
Do that right now, Matt. Connect the two.
Yeah, as Jordan Rochester has said a couple of times on this program this week, as we have those gas concerns, as we get closer to a rationing of gas use in countries like Germany, the economic concerns just skyrocket, and that's why you see the euro dumping down below $1.
I mean, Lisa here, and folks, the frenzy on a Friday is a cacophony. That's the word I would use here. At least it's like we're getting hit from all sides, and yet the VIX tells me equities have been resilient. Are we surprised?
Some people would say yes. At the same time, if you listen to Jamie Dimon, if you listen to so many surveys, the consumer still is spending. There still is enough strength. The job market is incredibly tight. So we're looking into a storm from a place of relative calm when we look at the economy.
Like that. Yeah,
and that is the conundrum that's causing some of the calm that we're seeing in risk assets.
Did we see a signal this week, Lisa Abramowitz, from credit, high yield on down to investment grade?
No, sanguine. People not necessarily seeing any kind of catastrophe. And how much is this because people are looking for yield and not seeing the default cycle in the same way as in the past?
We got retail sales this morning, Matt Miller. I think they're going to be as important, maybe more important than that 9.1% inflation report. And the shelter attributes of that inflation report really jump-started the persistency of inflation that some are guessing on.
Yeah, the retail sales number, to me, in conjunction with the bank earnings and the color that we get from those executives are so key, because we heard heard yesterday from Chris Waller. We heard today from Claudia Sahm, the sort of hopeful optimism that the U.S. consumer still has some money stuffed away from the stimulus. And on the other hand, credit card spending is rising. So the question for me is, how leveraged is this consumer to keep spending?
I do just want to bring up, just crossing the terminal, there is a correction, and it is a fairly big correction. I want to bring this to you. We talked about net interest income coming below $1 billion. It is corrected to being $10.92 billion versus an estimate of $10.15 billion, which coheres a little more with what the CEO is talking about, Tom, with respect to net interest. Huge correction. This is completely reversing it. They actually beat on net interest income, and that is actually helping to support their bottom line, as Charlie Scharf has been talking about in the press release.
We're going to have to stop the show right now. This is so important, folks. Bloomberg and the heritage of over a quarter century is when there's a correction, we really don't care who screwed up. We just want to report it to you because of market participants. Tell me in the control room what Wells Fargo stock is doing here pre-market. I assume it's doing better. We're advantaged with Shanali Basak with us right now as she looks at a mother of all corrections. Shanali, do we have any idea where the correction came from?
Well, the correction came up on the net interest income line, as you say. It is really important because they need to make money elsewhere. Remember, mortgages we were talking to are down. We had reported also that consumer banking has been doing a little better, marginally better, about 2% better in terms of revenue year over year than expected. So you do see other lines of the consumer business doing better. You have Charlie Scharf saying that loan balances are increasing, but net income did decline in the second quarter. So it is a mixed bag for Wells Fargo, but they need to earn on net interest income in the face of what they see as higher losses ahead in terms of credit quality.
Put up here what the stock is doing right now. It was down, I'll call it substantially here, off some grim news and a little less grim news here.
It's still down, which is interesting.
It's still down, okay.
Yeah.
It's the credit costs. I mean, that's the worry at the end of the day, that, yesterday's numbers don't give you tomorrow's success.
And we heard Thomas Show talk about that everything changes as maybe you get to a normal spread business in banking. Futures advance up 12, Dow futures up 119, the VIX 26.21. Very simple in the yield space. You got inversion. Let's pivot off a 10-year yield at 2.93%, well below 3% level. That curve inversion, 19 basis points, 0.19 percentage points difference, a higher 2-year yield, a lower 10-year yield. I do want to mention Italian spreads. They did widen out off the Draghi. Help me here, Lisa. Is it a resignation or
he tried to resign? He tried to resign, and the president rejected it. And so now they're trying to figure out what's next. But it has been a crisis in Italy, which raises serious concerns for the ECB, which wants to prevent spread widening for too much, and now has to face the prospect of being accused of political interference.
Okay, so up we went with a wider spread there, and German spread to Italy. Italy, take away the German yield, is a little bit grimmer than it was a week ago. Dollar resilient at 108.34 on DXY, and sterling 118.40. She has been more than patient, but an important conversation out of the land of the fighting Texas Aggies with G Squared Private Wealth. Their Chief Investment Officer, Victoria Green, joins us. And Victoria, it's nice to get away and talk to somebody that actually knows how important Texas A&M football used to be. Somebody at that game is going to go, I need to reallocate here. I need to have courage to be in the market. How do you reallocate amid this chaos?
I think you're looking for defense still. I think it's early to chase. We're not trying to buy some of the stuff that sold off the hardest. I think that is right now a value trap still. I think as earnings roll in, you can see they're all Mixed at best. United Health was good, PNC good, Wells Fargo, JP Morgan, Morgan Stanley were kind of more mixed and downtrodden. So listen to what these people are saying. A lot of these CEOs are not uber bullish. They're warning about loan losses on the banking side. So we're playing defense. We're looking to not buy this dip yet. We think it's going to leg down a little bit lower. We think the Fed's going to have to move. You've got a lot of pressures on the consumer. We talk about how consumer spending has stayed relatively stable, but that's because they're borrowing. And if you look what's happening on how much the consumer debt is rising, even though consumers have been spending and travel has been robust, it's not that they're saving. It's not that they're pulling this from cash. They're now adding to their balance sheets and adding debt. So something we're definitely watching, because we feel like the consumer is very, very stressed right now. And the U.S. economy lives and dies on its consumer.
So, Victoria, what does playing defense mean at a time when the Fed is very much in play and bonds have been out of favor for the majority of the year?
Sure, ultra short, right? We would focus on the 90 to 120-day Treasury bonds or some sort of ultra short duration. We don't want duration. We don't want credit risk. We want to be boring. I know that's silly, but boring is fantastic right now. So we want stocks that are making a lot of money. We're playing defense in health and staples. We're looking for companies with resilient revenue streams. We're looking with companies with a strong dollar that their revenues are more earned in the United States versus multinationals. So like a Ross store or a Costco that is mostly U.S. revenues. So you're going to be hit a little bit less on this dollar because I feel like that's a big headwind for a lot of multinational companies that's being underestimated now, because as the world continues to evolve and the U.S. relative to other countries is possibly going to tighten faster and raise rates faster, I don't see the dollar pressure easing off. I think versus the euro and the yen, because it's all relative depending on which currency, the dollar is going to be extremely strong for the foreseeable future.
Victoria, my good friend Paul Sweeney, 3-decade Wall Street veteran, his number one rule is don't fight the Fed. You point that out as one of your convictions right now as well. Is there a point when you change that? Is there a point when you see the Fed start to turn over that you do start to go in there?
Absolutely. If we have capitulation or the Fed starts to put anything dovish in, you know how we love to look at the meeting minutes and we parse out any tiny change in vernacular to see what they may be thinking. But I would be looking at the data. They're going to hike until something breaks, and either the economy is going to break, the labor market is going to break, or liquidity is going to break. Or last but not least, inflation might finally break. But those are the only four things we're looking at. What's going to give first? We're in this massive tug of war right now. High inflation, tight labor, and relative to the amount of hikes they're talking about, the markets absorb them quite well. Right. And the Fed doesn't care if Apple goes down. That's not their job. The Fed only cares about the market if liquidity dries up. So we're looking for all those canaries in the coal mine, but the Fed's going to need a reason to change. It's going to be status quo and hawkish until something changes in the data that makes them need to pause.
Victoria, I got to leave it there. Victoria Green, thank you so much with G Squared for being with us today. Lisa, I want to scope out here Wells Fargo with a drop down from a 38.80, almost a 39 level, down to middle 37, and we've made about halfway back on Wells Fargo with that net income correction.
They still have increased their provisions for credit losses, and perhaps that's what people are picking up on for a bank that is exposed to the consumer. They are saying that interest income actually was a huge benefit to their business and expects to continue to be given the higher interest rates, which makes sense given where we are in the environment. Going forward, it will be interesting to hear what they have to say about the mortgage business that has definitely lost favor with a lot of investment banks, considering the fact that mortgage rates are pretty darn high, and then also just how much they see the consumer weakening currently versus the strength that we hear from others.
On the screen right now, what's really of interest is the equity market with a very nice lift. Futures up 13, Dow futures up 128. And for the third day in a row or so, we have the larger indices leading the NASDAQ higher. That somehow changes in the afternoon, I would suggest, or at least when we get the market open. But right now, Dow leading SPX, fractionally leading on a percentage basis. NASDAQ went under. NASDAQ up 0.3% as well. We are going to continue. Most importantly, we continue to monitor the travels of the President of the United States. In the Levant, he will move south to an historic visit in Jeddah, the Kingdom of Saudi Arabia. Our Anne-Marie Hordern is in Jeddah awaiting the President. Please stay with us. Again, futures up 13 on a Friday. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Season is coming.
It's a low bar going into earnings season.
There are bargains out there to be had. Bloomberg is fastest with the numbers and analysis.
There's conflicting and complex cross-currents. Strap yourself in for this earnings season.
Bloomberg, the fastest numbers and analysis you trust.
I fully support another 75 basis point increase. However, my base case for July depends on incoming data. If that data come in materially stronger than expected, it would make me lean towards a larger hike at the July meeting.
One of the best researchers in America, and that would be Vincent Reinhart, who will join us later. And Vincent Reinhart of the Fed knows well that Christopher Waller is truly one of our great thinkers on economics, the governor of the Federal Reserve now after his ownership of research at the Federal Reserve Bank of St. Louis. I want to do a data check here, but I want to dive deeper into Jerome Powell is central banker of the world, and I want to bounce off Lawrence McDonald in his appearance yesterday and the great work of Damian Sassower. We quote the Dow, we quote the Standard & Poor's 500, we do the curve inversion in that. Focus. The 5-year yield in Egypt, Lisa Abramowitz, is 16.5%. It's gone from par down to 72 with 3 days of erosion this week. EM bonds are grim, according to Damian Sassower.
And according to every metric that you look at, not only because of a strong dollar, but because of issues having to do with commodity prices spiking, with a lot of these nations being commodity importers. And I think of Egypt and how hinged they are to Ukrainian wheat. I mean, if you think about the butterfly effect that is going on globally, it's roiling markets and creating some real distress.
As you prepare to get to July 27 in that Fed meeting, indeed the ECB tomorrow, let's remember people like Secretary Yellen and every other finance type, no doubt talking to the International Monetary Fund into August. Anne-Marie Horton knows all this, our Bloomberg chief Washington correspondent. It's 109 degrees in Riyadh, so she decided she'd go where it's cooler. It's only 100 degrees in Jeddah, so it's a good and strategic move for Anne-Marie. What kind of heat will President Biden receive from Mohammed bin Salman?
Well, we should also note, Tom, it's very hot in Riyadh, but it's much more humid because we're on the Red Sea here. And it's a great question because the president's going to be coming into a very difficult line to walk when he sets foot in the kingdom. He'll be meeting the king first, and then that meeting with Mohammed bin Salman. All eyes are on this meeting. This is really the pivotal moment of the trip. Mohammed bin Salman will likely be very gracious for the administration to come and meet him, especially the president. I'm not sure if he's going to get the same heat that there's been reporting that others in the administration have gotten from Mohammed bin Salman that he would do directly to the president. But I think he'll make it pretty clear that I am the individual, I am the king's son, and I am running the day-to-day operations for my father. So if you need something out of the kingdom, you're going to have to go through me.
Anne-Marie, how much are we going to hear about the potential capping of Russian oil prices, considering the fact that a lot of people don't think that the sanctions as is have worked of implementing more pain on Russia than the rest of the world?
Well, it's a great question, Lisa, because the administration wants to enact this, but really needs a lot of individuals, countries on board with this. Russia is part of OPEC Plus, and they have a strategic relationship when it comes to the energy market with the kingdom. But also, they have to still get all those shippers and insurers involved in this if they were going to have a price cap. But we should know what's actually happening in the market right now is that Russian oil is still leaving Russia, just heavily discounted. So a lot is going to India, definitely a lot is going to China, but also a lot is going into the Middle East. A lot of it is going through the port in United Arab Emirates into the Middle East and then being exported out, depending on whether or not it's going into gasoline, diesel, jet fuel. So there is already the market working in a sense of a price cap because Russian crude is heavily discounted to those buyers.
It's classic because those distillates are going straight back to Europe and straight back to those companies that sanctioned Russian oil initially, and of course Putin is just making a ton of money throughout this whole thing. Anne-Marie, back to Saudi Arabia, back to President Biden's trip. Before you were Washington correspondent, you spent a good decade going to OPEC meetings and covering the oil market really closely. Are we wrong to be worried about spare capacity? Because it doesn't look like a lot of OPEC nations have so much. Is that a distinction we should be making, the base level they can produce and the spare capacity above that?
It's a great question to be asking, and that you, yes, should be worried about in the sense that you have all these OPEC countries not even hitting their targets right now when you look at Nigeria or Angola or Libya for that matter. So there's really only two countries that have this spare capacity, which is the Kingdom of Saudi Arabia and the United Arab Emirates. And there's lots of question marks about how much spare capacity they do have. When they pumped at will, they were able to do it for about 3 weeks, and then that was it. So there's a question of what spare capacity do they have and how long, especially with the kingdom, could it last? Right. But the kingdom has always took a lot of pride in itself to making sure they can deliver those barrels on the market. But you have to think that if you have the UAE and the kingdom going full out in the oil market, prices will actually probably rise because they'll realize there's not a lot of spare capacity. So I imagine the conversations is for very much so a gradual increase of barrels to the market.
Anne-Marie, what is the price of this? What is the military hardware we have to migrate to Riyadh to protect them from the insurgents of Yemen?
Well, we're not sure exactly yet in terms of what the administration is going to sign off for. We do know that when it comes to the kingdom, there's been a lot more so conversations with the defense ministry as well as our Pentagon, and that they definitely want more defensive missiles, and that has been an ask for decades and years. I think what the kingdom, though, is looking more so from this visit is the fact that what it symbolizes to the region, which is that our partners are still here with us in the region, and the buck stops with them. The Americans are our strategic partner in the region, and they definitely want to send that signal, Riyadh, to Tehran.
Anne-Marie Horton, thank you so much. We're now an hour, maybe an hour and 10 minutes away from a most historic landing of Air Force One in Jeddah, and Anne-Marie Horton is there. I look at this, Lisa, unfolding all in, and it does speak to the regional stability, starting with Tunisia here, I'm going to say 2-3 weeks ago, not to be the gloom of an Arab Spring, but with yields in Egypt at 16%, it certainly speaks of Arab and Levant fragility.
Yeah, and actually we're hearing from Janet Yellen getting concerned about some of the flows, the fund flows into emerging markets, cautioning against some of the volatility there because it could become an area of much bigger distress. And you're right to point to Egypt because it is one of the key nodes and one of the key sufferers when it comes to the lack of wheat exports coming from Ukraine. How do we look at that and avoid some sort of social unrest if you do see the prices of the basic staples of the daily lives being risen that much?
Matt, I want to take 48 seconds here and talk about the gloom we're going to see on Wall Street Internet this week. We're going to do Wall Street Week tonight, Lisa Bramlett and myself. And you know, Matt, it comes out starting about 3 p.m. Friday, doom and gloom. Here's a single bullet from Douglas Cass, who trades often, sometimes makes money. He goes, I am buying. That's a lonely voice right now, Matt Miller, isn't it?
Yeah, absolutely, especially because a lot of people think we're only halfway through this correction. Gary Schilling told me that earlier this week, and Michael Burry has been tweeting it.
We'll talk about many different opinions, and tonight again, Lori Calvasina, David Bianco, I believe Professor Summers will darken the door as well. Tonight, Lisa Abramowitz and myself, Wall Street Week. This is Bloomberg. Good morning.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg Surveillance. Good morning, everyone. John Farrow off today. Matthew Miller in for Mr. Farrow, and Lisa Abramowitz here as well. Futures up 14, Dow futures up 149. The VIX 26.11 is a constructive statistic. Brent crude back above $100 a barrel gets my attention. And other than that, it's stasis. I want to take 12 seconds and note a grim Italian inflation report. It is out at 8% in June, back to 1986. But what's stunning in the report is for low earners, where they subgroup that out, it was 8.3% in the first quarter and 9.8% for low earners in Italy in the second quarter. The uneven burden of inflation is tangible. On individual securities, Lisa Abramowitz. Lisa, what do you have?
Tom, I really want to take a look at some of the bank earnings. We did get earnings from Wells Fargo showing that they did have pretty much inline interest income, which was a supporter. The negative for them was that they did build credit for credit losses that they expect to increase down the line. Those shares down by 0.8% at this point. Citigroup lined up for 8 a.m. And of course, we are looking at BlackRock as well. We haven't mentioned it. The shares unchanged, but it is interesting to note BlackRock reported earnings with a decline in the amount of flows that it's seen, with a decline in total assets and a decline when it comes to withdrawals from their active funds. Then if you take a look across assets, United Health was interesting. They also reported earnings, and they beat estimates by a significant margin, and they also increased their forecast going forward, which is interesting at a time when so many people are expecting healthcare costs to increase and actually contribute to some of the inflationary push. They are seeing more enrollment, 1.7% gain in pre-market trading. And then I looked at the Bitcoin sector, Tom, because Matt Miller is here, so I had to. Marathon Digital and MicroStrategy both doing pretty well today because of the Bitcoin gains that we are seeing. Again, marginal, but it shows how much these are really adding to the marginal move in frothier assets and the risk appetite.
Quickly here, Matt, what's the so what of the Celsius bankruptcy? Why do I care?
Well, the main reason that I care is because we show or we learn just how connected Sam Bankman-Fried really is. I mean, his FTX and his other funds have their tentacles deep into all of these different crypto lenders and businesses, and it's just amazing. Some have called him the J.P. Morgan of crypto.
Okay, well, how's the J.P. Morgan doing? 60,000 down to 20,000. J.P. Morgan itself says mining costs are 13,000. How's this guy doing given these losses?
Well, he still has $11 billion and he's only 29, so I think he's doing all right.
Okay, well, he'll be able to buy the Hummer HV, the EV, I should say, that John Farrow's looking at this weekend. Right now in the fixed income market, Michael Collins, Senior Portfolio Manager at PGIM, joins us right now. Michael, I love your research note where you talk about the relative value trade, the relative value rationalization that's out there amid all this volatility. You can't do it, can you?
Yeah, the markets, Jonathan, the credit markets are actually performing pretty in a pretty controlled way. I mean, this sell-off, as brutal as it seems, has actually been pretty orderly. But there are a lot of really good relative value opportunities, right? I don't know if it's a great time to jump in and buy rates or buy credit, but man, there are a lot of really interesting opportunities starting to arise.
What is a relative value trade? Construct a trade for us here in real time. I'm asking for a friend.
I mean, the easy one that jumps out at everybody that hasn't been working is just in our plain old staid treasury market, Tom. You know, that 20-year treasury, which they've talked about for a long time and issued a couple of years ago and actually put on a treasury future just recently, is really one of the cheapest bonds in the world on a relative basis. I mean, you know, this is a little inside baseball, but you can buy a 20-year treasury, sell a 10-year and 30-year treasury, so you have no interest rate risk or curve risk or credit risk, and pick up a lot of relative value, right? So that's something that really jumps out.
Lisa, that's like called a condor or a parakeet or a golden eagle. I don't know what that's called, but it's something.
It's called, well, Tom, it is called trading into a less liquid asset
means
that
everybody
actually
makes
gives
money.
you a bit more in terms of premium, and then you can cash out. But Michael, how much can you go into less liquidity for more yield at a time when everybody is saying liquidity reigns supreme?
Yeah, well, I mean, that, Lisa, should not be an illiquid asset, right? It's a 20-year on-the-run treasury that was just issued. They just did an add-on auction this week. They have a treasury future. I mean, that should be one of the most liquid bonds in the world, but it is, for some reason, trading, as you said, with this huge illiquidity premium that should not exist. So, I mean, that will eventually earn money. Maybe it'll take 20 years, right? But that will earn money. But there are other less liquid assets that are starting to feel the pain here too.
Well, and that's what I wanted to ask though, Michael, because when people go into less liquidity, they might be betting on a longer term outcome, but in the short term, there can still be those fissures that Michael Shaul was talking about, some sort of illiquidity crisis in a way. How much are you banking on that not happening by trading into certain instruments like this versus just saying it doesn't really matter because longer term is longer term?
Yeah, I mean, I get asked all the time about what are the cracks in the system, what are the things that could bring this, system down, and it's really hard to find them, right, Lisa? The credit quality, as we always talk about, in corporate America, in the high yield market, is really solid. Liquidity is good. The banking system, notwithstanding some of these earnings issues we're seeing, I mean, the banks are solid gold from a credit quality standpoint, right? They are really solid from a capital standpoint. The housing market, notwithstanding the fact that it's going to go down, right? House prices will probably be 10 or 15% lower in a year from now than they are now, but they are not owned on a levered basis, right? What I see
I just bought one.
Well, yeah, good. Someone's got to buy at the top of the market, man.
And I stretched.
So the areas that I'm worried about, Lisa, are the areas that are less liquid, that don't trade, right? So think of the private debt markets. Think of the commercial real estate markets, right? They're all still marked at par. If you had to sell 100 pieces of commercial real estate today, I mean, you would have to take a 10 or 15% haircut, right? That is something that has to still happen.
Michael, fortunately, I funded my purchase shorting JGBs. I can't believe we haven't talked about the yen an hour and 36 minutes into Bloomberg surveillance here at 138.70, and we've been above 139 the last couple of days. Is it like a no-loss proposition to short this currency as a carry trade?
Yeah, there's never a no-loss proposition in currencies, Matt. And I, tried to model currencies, 30 years ago, and it is really hard. They are the most difficult asset, if you will, to try to figure out a fair value on, right? And they tend to trend. And right now, the dollar, I think it's more of the dollar is going up, right? Every other currency is going down versus the dollar. And the great thing, if there is a great thing about currencies, is they are the great equalizer, right? I mean, the U.S. is the strongest economy in the world right now. We do have inflation. We have a central bank that's hiking rates aggressively, where some others are starting to blink. So the dollar strength will ultimately weaken our earnings, weaken our economy, get inflation back down, and support these other economies that need it.
What do you buy right now on the curve? I was talking to Gary Schilling, who's buying the dollar, but obviously he makes dollars also. He says he's buying the 30-year, the long bond right now, and that seems to be consensus.
Well, I talked about the 20-year, but that's kind of a nuance. But yeah, I think adding duration in the U.S. and maybe in other places in the world, actually European rates, even though they're lower than ours, there are more rate hikes priced in by the European Central Bank in Europe than there are from this point on in the U.S., and I don't think they're going to get those off. So I think interest rates in general have probably gotten too high around the world, and they are going to come down over the next 6, 12, 18, 24 months, and that, I think, is probably one of the first things to really add value.
Michael, what's a 10-year target here for you? I know it's really not the PGIM game to do a sell-side kind of guesstimate on the 10-year yield, but what is the PGIM feel for where the 10-year's heading?
All right, so let's say it's 3-ish right now, right? I mean, I think it's going to be 2 before it's 4.
Wow.
I mean, that's the long-term trade, Tom, right? I mean, the Fed might get that funds rate to 3.5, but in 2, 3 years from now, it's going to be lower. It might be lower in 6-12 months from now, Tom. I mean, that's kind of the part of the cycle we're in. We're in a big inflection point here. Economic activity around the world and in the U.S. is rolling over a lot harder, I think, and a lot more quickly than even the Fed would be comfortable with. Obviously, we have this stagflation risk, but ultimately, if you look through this near-term inflation issue, I mean, rates are going to be lower.
Michael, thank you so much. Michael Collins here with PGIM, really showing up the divide, Lisa Abramowitz, that we see from a distant 2% yield out to a distant 4% yield.
And right now what we're seeing is that a number of people, more people are weighing in on that 2% than that 4%. Just want to bring this to you, that there is a survey that was just published, the results of which show that about 50% odds of a U.S. recession currently are baked into the market and are currently what economists expect. That's fascinating. And within the next year, let alone after that, how much that has changed from just a couple months ago.
On to Citigroup earnings, and Lisa, thank you for mentioning it because it was off my radar, and I was really quite wrong on this. We have the proverbial Seattle slew of economic data today, and I'm sorry, retail sales could adjust that recession guesstimate that each of us has.
And it could adjust how far the Fed decides to go at their meeting in about 10 days. How much are they going to take this critical cue from the consumer strength or lack thereof? What's a worse print for the market right now? Higher than expected number if you get people actually going out and spending that encourages the Fed to be more aggressive, or a lower than expected spend that all of a sudden confirms some of the weakness that people are already baking into their expectations.
Matt, 10 a.m., the 5-year out, then 5-year out from that, the total 10-year inflation view of the University of Michigan. I guess we'll see how unanchored we are.
Yeah, absolutely. Although it is interesting that the Conference Board numbers aren't nearly as pessimistic as the U of M. It could be something to do with those Wolverines in Ann Arbor.
Well, I don't know. I would say it's extremely well said. There's huge divides here from the caution of Atlanta GDP out to more constructive data as well. We have constructive data in the market with futures up 12. The VIX 26.15, Dow futures up 137. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden wants Saudi Arabia to increase its oil output to help curb soaring gasoline prices in the U.S. He travels there today from Israel, but Bloomberg's learned that after the president meets with Crown Prince Mohammed bin Salman, there will be no public announcements on boosting oil supply. A person familiar with the matter says talks will continue regarding output from members of the OPEC Plus cartel. Senator Joe Manchin has delivered a huge blow to President Biden's ambitious economic agenda. Manchin, a Democrat, told party leaders he would not support new spending on climate measures or tax increases. Manchin says he will back proposals on health care and drug prices. The European Union is falling behind on its high-profile promises to deliver a substantial aid package to Ukraine. Almost 2 months ago, EC President Ursula von der Leyen proposed spending $9 billion in loans, but only a fraction of that has been agreed on so far. The EU is facing severe economic pain from inflation and the possible cutoff of Russian gas. The world's largest marketplace for non-fungible tokens, OpenSea, is cutting 20% of its staff. The company warned of a prolonged downturn amid the collapse in crypto prices and broader economic instability. OpenSea has seen its sales cut in half over the past month. The average price of an NFT on its marketplace dropped by nearly 40%. And the wave of airline delays in the U.S. this year is mostly self-inflicted. The share of delays caused by airlines, as opposed to weather or air traffic control, has surged to the highest level on record. That's according to data reviewed by Bloomberg News. Through April, airlines triggered about 58% of late flights in 2022. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
As far as Europe is concerned and the ECB is concerned, they're in a much tougher spot. There is a shutdown of Nord Stream 1 that's going to lead to a significantly sharp decline in growth. So policy that becomes a lot more tricky than it is in the U.S.
Exceptionally strong yesterday with a Subrata Rajappa, head of U.S. rate strategy out of Paris, Societe Generale. And I do want to note the ECB meeting next week. John Farrow and I are really quite focused on that. We think it's going to be more, we make jokes, it's a snooze fest. That's highly unlikely into next week. Someone who knows this is someone who lives where I sort of don't know where it is on the map, in Luxembourg, which is in the vicinity of Belgium, in Germany, and France. And that would be Sebastian Galli. He's done some good work over the years, always thinking with important research notes with Nordia, and Seb Galli joins us this morning. Lisa?
Well, yeah, Sebastian Galli, thank you so much for being with us, because right now we are looking at what could be a real storm in Europe next week, and especially with the Nord Stream 1 supposedly coming back online. At this point, what does the ECB do? How much do they try to get ahead of this, especially in the face of Italy?
Well, it's, as you can see, complex situation, as my colleague from Societe Generale was pointing out. It is not a good situation. The odds are very strong that the pipeline will stay closed or at a very low debit. And the reason is that we are in a war between the West and Russia via Ukraine, and they have to strike us because they have to hit the source of funding and the source of weapons going into Ukraine. And the ECB knows this. So it's faced, according to the Bundesbank, maybe with up to 2% higher inflation because of natural gas prices spiking even higher. So something which is fairly deleterious. And what can the ECB do when it's so far behind the curve? It needs to reassure. The ECB governor is very credible. She's a very good communicator. She's very reassuring. So she probably will do a very good job bringing the rest of the council with her. But she has to accelerate the pace of rate hikes when we're starting to talk about 25, 50, maybe a series of 50 basis points. Maybe they will surprise us with 50 basis points at this meeting. They need to reestablish the narrative. And having done so, they're left like the United States and hiking maybe too much because it takes a long time between the hiking process and inflation eventually coming down. And what the ECB is hoping is that oil prices collapse by themselves on the back of an expected global recession. The process has started. It might take a few more months, but eventually it should be much lower, and it will help very significantly not only the United States, but also Europe.
So, Sebastian, we were talking about the idea of the ECB going more aggressively, and it raised the concern of Italy, of peripheral spreads, of bond yields surging as the ECB moves away. The ECB came out, they said, we will control that. We will reinvest some of our holdings into other regions that need it. How difficult does it become from a political perspective, given what is going on in Italy with the potential disruption in government?
It's not sustainable. It's a blank check, right? Europe, or the Eurozone to be more precise, is a social contract that if you do the right thing, we'll do the right thing with you. But if you have parties such as Five Stars starting to break apart this contract, looking only at their own interests and not at national and European interests, then the entire thing can blow apart, as happened in several emerging markets. You can think of Argentina with the serial defaults. They default and default and default again. And that's a situation Italy is essentially faced with. Is, do they want to have a government of national unity? Well, they have the votes to do it even without Five Stars. So it's not as bad as it looks like. But the ECB cannot give something unconditionally to Italy without Italy delivering something. And that means from a legal point of view, but also from a political point of view, it is actually very difficult to have an anti-fragmentation tool, which is perfectly efficient. They can do a lot. They can surprise the market. It could give us funding, for example, to asset managers and wealth managers. And we would buy that European debt, and probably we would like to.
Yeah, I'm sure that would be great for you. And probably the governing council, for the most part, wants to do that with the transmission protection mechanism, the TPM, as I'm sure we'll all be calling it in a couple of days. Not Joachim Nagel, right? Not the Bundesbank. They're not all for this. How is that relationship going to work out?
Well, the right, Nagel represent, you have always this good cop, bad cop regime in Europe. Italy plays, or Spain will play the good cop, Germany will play the bad cop, and the French will basically oscillate between the two and try to play for the center. And this is how Europe essentially works. Nagel represents part of the opinion within the Eurozone, even within Spain, Italy, and France, but not one they can express on a plug-and-play basis. They say, look, there is a legal framework. Germany and Austria, also northern countries, are very important politically. So you can't give a free check, a blank check to Italy to do whatever it wants when Five Stars just does, well, spend more. There's no problem as long as it's for the people I care about. And so it just doesn't work. And the Germans say, okay, it's our time to play the bad guy. He's waited a long time to it. He's been very nice until now.
What levels are you watching in terms of spreads, Sebastian? We saw a BTP Bund spreads blow out to like 200, 220 basis points. What's concerning?
It's not that concerning, because what it tells you is that the market is really risk-seeking, in the sense we had PGIM coming before and saying, let's extend duration even in Europe. And this is something which is quite common amongst asset managers. They want to extend duration even though they don't have the data. We're still in that process basically of inflation overshooting and not being certain what the dynamics are, because they're so incredibly complex. And they want to extend, and as they extend, of course, it maintains curves at relatively low levels. So Italy might have seemed frightening for a while until the anti-fragmentation tool came in, or at least perception of it, but it could have been a lot worse. And what one should consider is that the risk reward is not particularly good right now, because the equilibrium is what we call unstable. It doesn't take very much either for it to go much higher or much lower. And I believe the ECB will do the right thing at the right time, but it's not a free check.
Sebastian Gelli, thank you so much with Nordea Luxembourg. Greatly appreciated this morning. Futures up 11, Dow futures up 136. Nice lift to the market with the VIX constructively in. Getting near a 25 level, which I would suggest is a huge deal. Lisa, as we go to Citigroup here, I believe it's in 6 minutes, I want to drift back to JP Morgan yesterday, where on first blush, there was a fair amount of gloom about that report. And I'm sorry, I saw a lot of news organizations say, yeah, but about 3 hours later.
Well, if you take a look at where the gloom came from, our first knee-jerk reaction was, look at that, they're suspending share buybacks. That must be them battening down the hatches for that hurricane. And then Jamie Dimon came out and railed against regulators, railed against the stress tests that actually required them to hold back on some of the share buybacks, or at least build enough capital, and said, things are fine, things are good, the consumer's looking fine. This isn't going to be some sort of Armageddon in markets. So, Tom, you're looking at right now a bifurcated message of the now versus the later, and we're hearing that from so many chief executive officers right now.
Oh, we're seeing that, Matt. And in the banking business here, I'm sorry, I'm going to go into the divide between the European banks and the American banks. Citigroup is their arch international bank. I mean, going into Europe right now seems to be a bit of a challenge.
Yeah, no, absolutely. Going into Europe has been a bit of a challenge for a solid decade, right?
Yeah.
It's always been difficult for foreign banks to come in and make money, and there aren't very many great examples of those who have.
We're going to get to that. Jane Fraser's going to report here on what Citigroup is doing. And again, off of Wells Fargo, was a little bit of confusion off a corrected headline there. Wells Fargo, Morgan Stanley, and JP Morgan out. We hear from Citigroup next. Futures up 11. Good morning.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
happening in Europe is definitely impacting what's happening in the U.S.
I think that actually we're pretty much near the peaking of the CPI.
Conditions are rapidly changing in front of our eyes, and I'm not sure people have kind of latched onto that.
One of the things that we're trying to adjust here is to a market that is more on its own.
I do think that recession is probably a little bit sooner rather than later.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Bank earnings and retail sales to stir the muddy soup. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John Farrow off, Matt Miller very much in. And Tom, I am looking ahead to those retail sales, to the University of Michigan Consumer Sentiment Survey, and how much can it actually direct a market that is taking cues from so many varied inputs that is highly confusing and reaching a stasis.
I'd guess that Jane Fraser is also going to be looking at retail sales. I will look at the control group, Lisa, and the answer is it was a grim number last time around. When you adjust for everything out, how is America doing as a consumer? And that's important to Citigroup.
Right now, we're seeing Citigroup reporting second quarter earnings per share at $2.19. They were dripping out as we get them, and we'll get to Sonali Basak. But one thing that we've noticed, and as we get some of these breaking news, Tom, we've been looking at the banks as a bellwether for a consumer that has not yet turned. So when you talk about retail sales, that's going to be an interesting note to understand how far along in that process we are.
Well, it's different to see in the headline sequence here of Citigroup. It's a clumsier release of data than we see from the other banks. With some of the banks, folks, we can really see right away that J.P. Morgan's struggling here. The first blush I have out of Citigroup is really not all that. With we have a tendency within 3 zip codes of New York, folks, to go to what's called FIC trading, and there I see a pretty good statistic, Lisa.
Well, we are looking at a headline earnings per share beat of $2.19, and Matt, that was the estimate of $1.69. You saw this FIC sales and trading beat of $4.1 billion versus an estimate of $3.8 billion. We are seeing a better than expected kind of result trickling out from a company that really has faced so much trouble and turmoil in terms of turnover in upper staff as well as mission.
I mean, I don't think there's any clumsy drippiness here at all. It's crystal clear. It's a beat that knocks the cover right off the ball. Citigroup EPS $2.19, estimate $1.70, much better than expected. Citigroup revenue $19.6, estimate $18.4, much better than expected. Citigroup trading revenue $4.08 billion, estimate $3.84 billion, much better than expected. I mean, bang, bang, bang.
Yeah.
These headlines come out as beat, beat, beat.
And right now you're seeing the shares go up, 2.3% pop in those shares pre-market trading as some of these headlines are registered. Sonali Basak, our stalwart Wall Street reporter here, parsing through some of the numbers. Sonali, what do you got?
A few things here, Lisa. That fixed income trading beat is massive for Citigroup. Remember, Jane Fraser is trying to turn around this bank, exit operations, but also invest. And now you're seeing that in the results for their trading desk in an era where J.P. Morgan missed Wall Street expectations. Remember, currencies, commodities, these are the trading desks of the season. And so winning on those counts for something, certainly here. Remember, I would also say you are seeing provisions tick a little higher up. We will look for more color from that from Citigroup, especially because they have that big global weighting. Are they worried about recessionary forces elsewhere in the world? And I've got to also say, they simply just beat on revenue. Remember, for Citigroup, they were trading at half of their book value relative to any other bank, big bank in the United States, Lisa. They were cheapest. And so you do see that lift in the shares this morning off of this beat, especially because good news is very welcome news in a very tough environment.
To be very clear, Sonali, when we talk about beating expectations, it's both a call on the expectations as well as the performance of a firm. How much does this speak to a broader macro backdrop versus a specific underestimation of the turnaround affair that John Fraser is running over at Citigroup?
It's interesting. You and I were talking about this yesterday, that the trading desks needed to save the day here because there are muted expectations. Net interest income is already really baked in here. There's not an expectation that higher interest rates will help much more than they're already starting to help the banks. And so to stand steady in trading is really important right now because you could just as easily start losing a lot of money in that business once volatility gets out of control. But you guys have been talking about it constantly on this stimulus program, volatility is not out of control. It is in a sweet spot. And you're also seeing Citigroup, in addition to fixed income trading, really meet expectations on equities, which is in a tough environment right now with such little issuance.
Well, and Citi is unique among these banks in that, as Tom was talking about earlier, it's the most international. It reaches across the Atlantic Ocean, not only into the continent of Europe, but into Russia. And that's been an issue here. What do we know about Citi's exit from Vladimir Putin's Russia?
You know, it's funny. We spoke to Jane Fraser just a couple of months ago over in Los Angeles. She was just getting off of a trip from Poland. And what she said to me was, we're getting on with it. So they are doing as much as they can, as fast as they can, to exit their operations in Russia, but also in elsewhere in the world where they had said they would.
Well, Sonali Basak, thank you so much. We'll get you some more. I'm giving you some more time to really parse through these numbers and get back to you later in the hour. This all bleeds into the broader picture, which is perhaps investment banking has been suffering on the deal side, but trading very much an interesting moment given all of the volatility. Jeff Yu has been tracking all of it as senior EMEA market strategist at BNY Mellon. And Jeff, taking a look at the soup of this week, what will emerge to you as the most important data point amid earnings, amid retail sales, amid consumer expectations?
Retail sales plus U.S. corporate earnings equals U.S. continues to outperform. You know, this is a view which somewhat goes against our expectation that the dollar's valuations were starting to look a bit expensive and the like. But the fact is, if you look at where Eurodollar's trading, you look at where cable is, you look at Asia struggling, China's growth struggling, the U.S. is still where they're at. So those asset allocation flows will probably still continue to favor the U.S., but selectively.
Jeff, I've been dying to talk to you. You and I have read James Hamilton of the University of San Diego, and we understand Brownian motion, which is the back and forth, the randomness of a trend, and these two odd words, drift and trend. Japanese yen is looking like a zombie. I was thunderstruck on yen weakness that the way it was weak. What do you make of the mathematical lethargy of weaker Japanese yen?
Governor Kuroda will very respectfully and politely tell you that this is still not the right kind of inflation that Japan is getting. It's irrelevant as far as he's concerned. He's going to say, sure, that's going to drive higher prices, imported prices. He wants to see wages grow up. But if Japanese corporate behavior does not change, then will that help his case for tighter policy? No, it won't. So if we go through U.S. corporate earnings, you know, what are their wage costs? Is that eating into U.S. margins? It may hurt earnings, but I think that's a good thing. It keeps the U.S. consumer afloat and flourish even. That probably isn't happening in Japan, even though their wage benchmarks are 110.
At what level of weak yen? 110, 120, 130, dare I say 140, 150. At what level of yen does the flourishing end?
I'm glad you asked that. It ends for Kuroda, it ends for the Japanese Ministry of Finance when Madam Yellen calls her counterpart in Tokyo and says, enough is enough. This is getting to where we were in the 80s. Do we need a new accord? Right. What's the best hotel in New York to sign it?
Lisa, on an international basis, what you just heard is the quote of the week from Jeffrey Yu. Secretary Yellen is going to call up and say enough.
Yeah, and that's
exactly
definitely
what's going to happen.
Well, perhaps that's the case right now. She's backed away from some sort of coordinated effort to support the yen. And Matt, you've been covering that as well, and sort of what this means. Yeah, what this means in terms of this as being a breaking point that's going to have to happen.
I mean, I think she has to wait at least 2 weeks before a complete and total 180, right? She just said at the beginning of this week, G7 currencies are not to be messed with. The free market mechanism has to be left on its own. Jeff, the question for me is how long until the market can break Kuroda, right? They continue to short this yen. They continue to short JGBs. And I know it's unique in that the Bank of Japan owns more than 50% of all of its domestic sovereign debt. But how long can they hold on?
Well, the yen and JGBs, those are very different things, right? So the yen, again, we go back to those conversations between the finance ministers, and Kuroda himself will say, this is not my purview. FX policy belongs to the Japanese Ministry of Finance. So that's where it's at. But JGBs, still not the right trade. That's where Japan comes through. I'm still looking for a bit of an RBA-like scenario, what we saw last year, where one day the market is in, they're looking for bids from the BOJ, there's no one on the other side. That's when expectations are going to come. And that's where we get the multi-standard deviation move in Japanese asset volatility and triggers the end of it.
This is so important, folks. We're going to extend Jeffrey Yu today. I know Global Wall Street will love this. He is with BNY Mellon, but what we're going to do here is really focus on EM. Damian Sassower of Bloomberg Intelligence out with an absolutely blistering note now, this weekend, I should say, in the last hour, I should say, for your weekend reading. And Sassower minces no words on the deterioration that we see in EM. We're going to continue that with Jeffrey Yu. I don't even know where to begin, Lisa Bramwitz, on EM. We can go to something idiosyncratic like Turkey, but Thailand is not idiosyncratic.
Yeah, you're seeing these pockets. How do they keep up with a Fed that's going to raise rates? And how do they keep up with the haven trade of going into the dollar at the same time that they're facing inflation issues, at the same time that they need to import basic commodities that are facing structural challenges that are causing prices to rise? It's messy out there, and you're seeing that reflected by the price.
Sticking on that and trout fishing in Idaho, I believe Mr. McKee will get up in the stark, cold Idaho morning. Lisa, retail sales, a big deal.
Retail sales. Also, later, we're going to get University of Michigan consumer sentiment. Also, the Empire manufacturing data. A peripheral one, but interesting nonetheless.
Citigroup. Maybe it's a new Citigroup. We shall see. Futures up 7. Dow futures up 112. The VIX near a 25 level. That's a wow statistic. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden travels to Saudi Arabia today. Bloomberg's learned he'll leave the Middle East without any public announcements on increasing oil supply. The president hoped to come away with something that could help curbing soaring gasoline prices. The president meets with Saudi Crown Prince Mohammed bin Salman today. He'll talk with other leaders from the oil-exporting Persian Gulf on Saturday. And President Biden says the time is, quote, not right to restart negotiations between Palestinians and Israel. Still, after meeting with Palestinian Authority President Mahmoud Abbas in Bethlehem, he said he would look for ways to reinvigorate the peace process. Abbas urged the president to take steps towards a two-state solution, which Biden has long said he supports. And in the UK, the race to succeed Boris Johnson as Conservative Party leader and Prime Minister goes on TV today. The 5 remaining candidates will face off in a televised debate. Former Chancellor Rishi Sunak and Trade Minister Penny Mordaunt pulled ahead of their rivals in the second round of voting Thursday. The next ballot is Monday. And China's economy grew at the slowest pace since it was first hit by the coronavirus 2 years ago. GDP rose at less than expected 0.4% in the second quarter. That underlines the impact the strict COVID-0 policy has had. Beijing is now likely to miss its goal of about 5.5% growth for the full year by a wide margin. And clients at BlackRock didn't put as much money into the firm's long-term funds as analysts expected. Net inflows totaled $69 billion for the last 3 months that ended in June, $40 billion less than anticipated. BlackRock's total assets under management fell to $8.5 trillion. They were at least $10 trillion near the end of last year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think they're misjudging neutral. The 2.5% neutral rate is a neutral rate that existed when inflation was still at 2%. We're not at 2% anymore, and it's a nominal rate. So that neutral rate is probably higher, and I think the Fed has got some work to do.
Conrad DeCadros really on fire yesterday with Green Capital, and I'm not going to mince words here. Lisa, help me here. I think it's so important. There's a gap here of 2%, 2.5%. We heard that from Michael Collins at PGIM earlier. And then there's 3-ish. Is that right, Lisa? Center tendencies like 3-ish?
Yeah, that basically priced into the market right now is 3.7% for an end of the year Fed funds rate.
And there's a group out at 4. Green Capital is out at 4.5%.
Well, and then get this from Jim Reed over at Deutsche Bank saying that 10-year Treasury should be below 2%. So talk about a bifurcation of views.
So there's where we are on the weekend and into the weekend reading, and some of that is tangential. Let's play that you're Secretary Yellen and you need a brief on EM, and there's no one better we can do that with. And Jeffrey Yu, he's Senior EMA Market Strategist at BNY Mellon and carries all the heritage of Jonathan Anderson at UBS from decades ago. I want to talk, Jeff Yu, about the Thai baht in a 20% depreciation off of the pandemic, and all of that is strong dollar. I get that. And as I mentioned to Dr. Alarian earlier this week, JP Morgan EMFX is basically on a decade-long 48% decline. Powell is central banker to the world. How fragile is Jerome Powell's Bangkok? How fragile is his Jakarta?
Well, unfortunately, all roads lead to Beijing, right? If the borders don't open, there are no Chinese tourists filling the coffers, filling the current account of ASEAN nations of Southeast Asia. It's still going to be a struggle. You know, these countries, and we're anticipating reopening. You just can't turn around an economy like that and from services-based into something more self-reliant, self-contained overnight or even in the course of 2 years. So it's still going to be quite tricky, but a lot are hiking as well. They know they can't take this.
On a relative basis, with the Arthur Burns-like magnitudes of American central banking, witness Bank of Canada this week, How does EM adapt to that besides constructively lifting rates like we saw in the Philippines this week?
Well, there are two ways. One, you've got to move on rates, which has been seen and above and beyond market expectations. But two, you've got to realize, and as the rest of the world has been doing, we are in a world of deglobalization. Your previous supply chains, your previous sources of export revenue, they're going to be there, not going to be there anymore. So invest domestically. The good thing is no one's talking about balance of payments crisis. No one's talking about 1998. There's no dollar leverage globally. Very limited positioning in global markets. Have a credible fiscal and growth strategy, and as that barbell with US equities and fixed income one side and the US dollar cash on the other side, as they seek to fill the middle, I think EM, especially in Asia, will be in a good place to hold that, but it's going to take time.
And Jeff, in the cross currents of EM and the dependency on the dollar, how connected is something like the retail sales figure that we're going to get out in about 10 minutes time, or even the University of Michigan confidence survey, because of how much permission it gives the Fed to raise rates even further than what people are currently expecting?
That's absolutely a nail on the head. It's no longer a story about, oh, well, US consumers and buy exports from the rest of the world. It's how is this going to push the head? Because if it really pushes the Fed towards a 100 basis point hike, for example, then whatever expectations that any EM central bank had for their next meeting, you add 25 on top of that. You add 50 on top of that. You need to run faster just to stay still. That's the challenge right now. And you're not getting any help, especially in Asia. You're not getting any help from China right now. And some are starting to keel over. Look at Central Eastern Europe, 200 basis points in cuts being priced in now by Poland and Czech Republic, because they need to do so much now. They'll have to cut aggressively later.
Are we going to see 100 basis points? I mean, Jeff, the market pricing has gone up and then back down, now maybe headed back up. But, Neil Kashkari unveiled his dot plot with 3.9% at the end of this year and 4.4% at the end of next year, and he's a dove.
So I think 75 should be the consensus for the time being. Now, here's the thing. We should have markets pricing in 4% terminal or above 4% terminal. So that's key. But pricing in doesn't mean we get there. By virtue of pricing that in, that's a tightening in financial conditions. If that can tame inflation expectations as well, we don't have to get there, but that process needs to run the course, and we're not there yet.
Jeff Yu, thank you so much. Generous of you to join us for this extended visit. He is with BNY Mellon, and he's watching what I'm watching, which is the Pacific Rim. We need to stop now midway through our bank extravaganza with Sonali Basak, and I really take issue with, I get it, the short-term good news report on Citigroup, I get. Let us remember that this was a train wreck, and Jane Fraser's picking up the pieces. This was a 1-for-10 reverse split a zillion years ago. For fossils like me, a $44 stock is really $4.41. If you look back to 2007, it's basically the other banks with Moynihan coming on and Citigroup an absolute train wreck. And as Sonali mentioned earlier, where you see it is in book value, that ancient old world ratio. Citigroup, less than half book. JP Morgan premium priced 1.25 book, and even dog of dogs, good morning John Stump, Wells Fargo almost out near 1x book. This shows the task Jane Fraser has.
Yeah, and it's pretty amazing, Tom, how quickly she's starting to pivot the bank.
How's she doing it? Is she just screaming?
Well, listen, the investors
is
initially...
she like Sandy Bernstein, where she's up on the table, running around the table, screaming at people?
She has a different style.
What's the style?
It's an effective communication style, and she calls it the school of empathy. And so that is a very different style from the Wall Street of old, as we all know. But it is an effective communication style where she's taken thousands of employees. Yeah, Tom Keene is laughing at me, but it is a different type of...
Is Jack Black going to be in this movie?
You can ask her who she wants to play Mark Mason, especially because her and Mark Mason, the CFO, they operate as a very tight-knit group, and they are aligning thousands of employees around them to guide this transformation.
On a conference call, are they just cutting costs? It seems like there's more pixie dust than that.
They've recently also said that they are going to be spending also not just to exit certain operations, but you see it in the fixed income numbers. You see it in the advisory numbers. You see them beating on expectations in advisory where many have failed. And, again, they have a long way to go. I don't want to overstate this. However, their investments paid off, at least for this quarter.
Well, let's go to the professor at the School of Empathy, Lisa Abramowitz, for observation.
Thank you.
The School of Empathy.
Thank you, Tom. I want to pivot
So
to retail
sensitive.
sales. I'm just going to totally go and do another
we should.
segue. Shonali Vasic, thank you so much. I do want to just take a look at what we're looking for in terms of retail sales. The expectation, the headline number for the control group is for a gain of 0.3%, which trails inflation. Tom, it will be really compelling to look at the gas expenditures mixed with some of the other expenditures and how that parses out to indicate how much people are deciding what they buy, given the prices elsewhere.
I'll go with that. McKee's way better than this, folks, but Lisa brings up the key point here, which is like a lot of other statistics. These are really inflation phased, inflation adjusted, inflation beaten up. But we'll get that retail sales, and Michael McKee will give us the inflation adjusted perspective we can as well. And then, outstanding on wage inflation, Thomas Purcelli will join us from RBC Capital Markets. Red and green on the screen. Market gives back a little bit. Stay with us.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali, masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that. Bloomberg Television. Top experts. Great questions.
Good Good morning, everyone. Bloomberg surveillance for the retail sales out here. We are thrilled that Vincent Reinhart will darken the door here in a moment. The last time he was on, he was nothing short of outstanding. But first, we have to look at, well, the import price index and retail sales, and then on we go at 9:15 and 45 minutes to industrial production. And there we go to the really interesting thing. I was never a big fan of this, but the University of Michigan statistics at 10 a.m. As well. This comes out the sort of the way that Mike McKee fishes. He's on the South Fork of the Snake River, and he sort of takes the fly rod and drifts it out and launches in to see how the water moves. And then the data comes out ever so slowly from the fishing, and he reels it in and takes it out.
This is Tom's way of saying that data is late. That is what he's trying to say.
Tries to not hook the line into David Kotok's line, and then they pull it in ever so slowly as they wait for the data from the river to come out. And I sit in the line, and I've got the little spinner, Lisa, with a red and white pop thing that floats along.
Yeah, and here it is. You caught something.
With a worm hung on it. And with the worm hung on it, I get the bites, and they don't. Let's go to Michael McKee as we finally get a little bit of data out here on retail sales. Michael, is it America buoyant?
It is America buoyant. Retail sales up 1% on a month-over-month basis. It's a little bit better than we saw, than we were expecting, and it is certainly better than it was the prior month. Retail sales had come in down 0.3 on a headline basis. Now, ex-autos, ex-gas, retail sales up 0.7. So gasoline taking a bite out of that. And the control group that you were talking about, we're still waiting for that calculation to be made. That's a calculation you do take out gasoline, food, and building materials. And now that comes in at up 0.8% after being flat the prior month. So an 0.8 gain, which is good news, even given the fact that you have to deflate all this on an inflation-adjusted basis. Pretty much all of your retail sales are going to be negative for the month. The Empire Manufacturing Index does show improvement, 11.1 from minus 1.2, and their price indexes fell during the month. This is the first of the major regional manufacturing indexes to come out. It pointed to a down month last month, and that's what we got. Import prices up 0.2%, and you take out gasoline and they were down 0.4. So petroleum is making a big difference when we see the numbers for import prices, and of course we knew that that's having a big impact overall on retail sales. Let me just look at the revisions to retail sales. We thought they were down 0.3 last month. They were only down 0.1. So that's also a little bit better, not going to make a whole lot of difference to the Fed. And they were down in the control group 0.3, and we thought that was flat. So bad news on the control side and better news on the headline for the prior month. But what we're looking at here in terms of retail sales for gasoline, I'm just squinting at the numbers here.
Yeah.
Gasoline stations.
I use glasses, Mike.
Up by 1.1%. Yes.
Well,
Sorry,
we'll let you. No, it's fine, Michael. Mike, we'll let you parse through the data with more granularity. Just want to bring you that what the reaction is in markets. The knee-jerk reaction is fascinating because what it seems to indicate is that just a touch bit of better than expected news would give more leeway to the Fed to hike rates. You're seeing a pop at front-end yields, the price down, yield up 3.17%, and the knee-jerk response in equities was lower, crossing into the negative. And then going positive, fluctuating around zero for the S&P, with the NASDAQ down about 0.1%. Mike, how much does a data point like this that comes in marginally better than expected, still negative on an inflation-adjusted basis, change anything for the Federal Reserve?
It probably doesn't change a lot. Most Federal Reserve officials that we've heard from have come out and said 75 is their base case, and they would consider going to 100 if things looked bad. Right now, things look about the same as they were. So maybe, is it a green light? No, maybe a yellow light for 100 basis points. They'll have to make the decision based on something else. That may be the Michigan numbers that come out later today.
Michael McKee, thank you so much. Greatly appreciate it, and safe travels. Seriously, Michael, this is a joy always to speak with Vincent Reinhart. He and Carmen Reinhart, his wife, wrote the essay of the pandemic on the global slowdown. that now very much is clear. And on a global basis, they absolutely nailed the pandemic slowdown, some of it due to the political and social policies seen in Asia. He is chief economist at Dreyfus in Mellon. Vince Reinhart, the last time you were on, you were absolutely lights out on domestic analysis. This morning, I have to speak to you about Jerome Powell, his central banker to the world, and his good fortune to have Secretary Yellen assisting an EM crisis. Moments ago, folks, the nation of Chile intervened in currency markets to provide for an appreciation of the Chilean peso. What's shocking, Vince Reinhart, is even with the intervention by Chile to strengthen the Chilean peso, it barely moved the needle. Vince, moving 2 standard deviations, at best, it's a 27% appreciation across what they need to accomplish given the damage. At this moment, how urgent is it for Secretary Yellen to speak to Kristina Georgieva of the IMF about EM falling apart?
Look, when the Federal Reserve raises interest rates, and we know the Federal Reserve is raising interest rates, that pulls capital into financial centers and away from EM. EM had a tough pandemic that they could in part smooth over by fiscal largesse. That deteriorates balance sheets. And we're going to be seeing that in the year to come. So it's going to be a tough time for EM. Anytime the Fed is in a firming cycle, it's tough for financial conditions generally.
Right.
And this will be an extremely tight firming cycle.
Vince Reinhart, across all of your academic work, there's always the amateur compare and contrast with 1998. I'm going to call that a time of naivete and a time of leverage. Do we have comfort now that we're less naive? Do we have comfort now that we're less leveraged than August of 1998?
Look, anytime financial prices move a lot, you learn something about somebody's balance sheet. You don't know who that is and what you learn. So I'm not going to say that it's all clear. What do we know? We do know big banks are much better capitalized and are more rigorously monitored, witness the stress test. We do know there's a lot more transparency in the documentation, lots more reliance on the big utilities of clearing and settlement. That's all good. We also know, among other things, that the Treasury market is less liquid now than it was back then. That's part of the consequence of QE, part of the consequence of big Treasury issuance, and it's also part of the consequence of asking big banks to have a lot of capital. They don't really want to commit as much to trading as they used to.
And they're shoring that up.
I'd say it's a mixed bag. Yeah.
And, I mean, what a great position from which to go into a recession, Vince, right? The big banks shoring up their fortress balance sheets. The consumer has money in the bank, and there's unemployment rate at 3.6%. Do you think we're in a recession?
So I sort of interesting. Technically, might we be in a recession? I'll await the Atlanta Fed's GDP now for later in the day. Retail control was better than expected, but last month was revised down, and quarterly arithmetic counts that more important. Don't know if we are. It's not much of one because we've had 400,000 jobs nearly printed each month for the last 4 months. I worry about the recession later in the year and next year. That will be more significant. If we're in a recession right now, it's mostly an inventory and a trade cycle, pretty damp. But it might just mean that the slope's going down to the more significant problems we have later in the year as the Fed tightens more.
Vince, just real quick here, given the consumer data that we've seen and the fact that they do continue to spend, whether it's with credit cards or not, their balance sheets look like they are in a pretty good position. How quickly could they turn over to achieve some of the negative scenarios that a lot of forecasters have out there?
Yeah, and added to your list is the retained saving from all the fiscal largesse of 2000 and 2021. That's still over $1 trillion. So that helps households. Unfortunately, helps. It's skewed to higher income households who manage their balance sheets better. So I think there can be some issues going down the road. Remember also that, the unemployment rate is 3.6, but real wages are declining. So actually, real household income is going down. That will be a problem. And then the last thing to note is some of the benefits households have had from government policies are more forbearance, not forgiveness. That's going away, and that therefore will expose their balance sheets more. It's not going to be a household recession, I don't think. I think households are better positioned in the U.S. Not as obvious in other places of the world, but the U.S. is more of that fortress balance sheet.
Vincent, thank you so much. Dr. Reinhardt with Dreyfus and Mellon this morning. Vincent Reinhardt, of course, has decades of work at the Federal Reserve for the nation. Lisa, I looked at a chart while you were speaking there I've never looked at, which is Chilean GDP in U.S. dollars. They've been in a malaise for 6 years. I mean, we don't talk about this stuff enough.
I love
and
it.
There they are.
While you were
malaise
speaking, I was looking at the
years.
Chilean peso instead.
Never looked at it.
No, it's a fascinating moment as they try to support their currency. And they've actually been selling some reserves as a result. Having lived in Chile, I understand what a big move this really is. We will carry forward the discussion about some of the turmoil in markets coming up on the open as Anastasia Amoroso, Chief Investment Strategist at iCapital, will be joining us as we take a look at a relative calm after a tumultuous week. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden wants Saudi Arabia to increase its oil output to help curb soaring gasoline prices in the U.S. He travels there today from Israel, but Bloomberg's learned that after the president meets with Crown Prince Mohammed bin Salman, there will be no public announcements on boosting oil supply. A person familiar with the matter says talks will continue regarding output from members of the OPEC Plus cartel. Senator Joe Manchin has delivered a huge blow to President Biden's ambitious economic agenda. Manchin, a Democrat, told party leaders he would not support new spending on climate measures or tax increases. Manchin says he will back proposals on healthcare and drug prices. The European Union is set to propose a new slate of sanctions on Russia for the invasion of Ukraine. Bloomberg's learned the new measures are expected to target Russian gold, introduce more trade restrictions on machinery, and add more than 50 people and entities to the sanctions list. The EU will also tighten previously approved sanctions. Well-known luxury brands are being hammered by China's COVID-0 approach. The maker of Cartier jewelry, Richemont, says sales in mainland China plunged 37% in the 3 months through June. The British company Burberry, known for its trench coats, saw its China sales fall 35%. Both companies said the situation started to improve last month. And that wave of airline delays in the U.S. this year is mostly self-inflicted. The share of delays caused by airlines as opposed to weather or air traffic control has surged to the highest level on record. That's according to data reviewed by Bloomberg News. Through April, airlines triggered about 58% of late flights in 2022. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
A price cap on Russian oil is one of our most powerful tools to address the pain that Americans and families across the world are feeling at the gas pump and the grocery store right now.
The Secretary of Treasury, who I think is way, way more busy than any of us matter. We just had a Chilean intervention on peso, and I would guess that she will have an international weekend in close discussion with the International Monetary Fund. An important report out moments ago. Ian Lingen, who we adore at BMO Capital Markets, flat out leads retail sales inconclusive for 75 basis point or 100 basis point debate. Thank you, Mr. Lingen, for that research note. We protect all of the research of our guests. Check with BMO Capital Markets for Lingen wisdom. Right now, the wisdom of Kriti Gupta on the oil fields of Saudi Arabia.
Saudi Arabia, Tom, where you are seeing spare capacity get lower and lower and lower. One of the cushions in the oil market right now is simply that if President Biden perhaps goes to Saudi Arabia, has those discussions, will OPEC and its partners, well, specifically Saudi Arabia really, and I want to say the UAE as well, which has that spare production capacity, can they turn on the taps and help this global energy crisis, of course, in the wake of the war in Ukraine? And that brings me to my chart of the day about just how much ability they have to do that, specifically Saudi Arabia. Here we're looking at their entire production capacity minus how much production they actually have. In other words, how much spare capacity does Saudi Arabia actually have? We're going back about 10 years, or I say 20 years. The first 10 years of the century, you are seeing an uptrend, then a downtrend, and then it goes even further. A lot of that having to do with the shale boom, the COVID story, Houthi attacks coming from Yemen. The end of the chart, the big takeaway here is that Saudi capacity is not where it was at, say, at the beginning of the century, and that is dangerous for an oil market that is perhaps depending to some extent that they can simply turn on the taps, Tom.
Kriti Gupta, thank you so much. If you are in the oil business, you must read cover to cover Daniel Yergin's classic, the prize. Even to this day, 20, 30, 40 years old, it's still definitive read. Will Kennedy joins us now, Senior Executive Editor for All of Energy and Commodities, who's read the prize 3 or 4 times, cover to cover. Chapter 21, Will Kennedy, the post-war petroleum order. How does President Biden want to change the petroleum order on this historic afternoon in Jeddah?
He wants to make up with Saudi Arabia, essentially, and he wants Saudi Arabia to have America's back in helping them to manage the oil market in a way that suits the U.S. economy. Those conversations haven't been happening as much as they used to. I mean, they've been happening in the last few months as people have prepared for this trip. And, you know, he wants them to keep happening. He wants Saudi help. Now, as Kriti explained, there is perhaps not as much help as the US would like, but I do think the conversations have evolved in an important way. From what I understand is that in Washington, there's a recognition that they shouldn't pump all the oil they can now, that it's in everyone's interest to maintain some measure of spare capacity in case we get a bad hurricane later this year. So what that means is he may, down the line, get some more OPEC oil, but no one's expecting it to be a flood of OPEC oil. So a little bit more.
Will, what it looks like is that candidate Biden wanted to project an image of someone who was going to change the petroleum world order, but President Biden realizes he can't do that and must maintain the status quo. Is that the case?
I think you could put it like that, absolutely. And of course, one of the things that has really changed in the petroleum order, and it will probably shake the order for years to come, is the war in Ukraine, and that's forcing people to reevaluate things.
Well, in what sense? I mean, it looks like Europe, for example, isn't buying Russian oil, so Russia sells it to the Indians and Chinese, and they turn it into the kinds of products that the Europeans need in the end. They do buy it.
There is some truth in that, of course, but we should remember that the war has meant that we've lost about 1 million barrels a day of Russian production. That's quite a lot at the margin. That's 1% of, or thereabouts, of global production. That's had a big impact. We've lost a lot of access to Russians' refining capacity. That's had a big impact on the price of diesel, especially in Europe. So the impact has perhaps not been quite as huge as people expected at the start of the war, but it has been significant nonetheless and should not be dismissed.
Will, the level of surprise here of Brent crude, 124 down to wherever we are right now, 102. We're down $20 on Brent crude. Should we be surprised, or is that normal in your world?
I think there are two things that have really put a lot of pressure on Brent over the last few months, and they're related, of course. One is that people are concerned that there will be a recession, and that means that demand may not shrink, but it will grow perhaps less quickly than people expected. And secondly, we've had a really strong dollar, and traditionally that's very bad for the oil price, and I think we've seen a lot of that there. But what's important, and people are trying to understand, is there's a real contrast between the futures price and what we're seeing in the physical market, where things look still very tight, and that's what's got to be resolved. Yeah.
Will, thank you so much. Greatly appreciate it. From Queen Victoria Street here, Senior Executive Editor for Hydrocarbons, here where the President will visit Jeddah here in short order. In the time we've got left, I think we've got to take advantage of Matt Miller's encyclopedic knowledge of a Germany not flat on its back, but certainly a Germany, to use the cliche, in original territory. Matt, what is the anecdote you have heard about the panic in a heated July as Germany confronts a less heated November and onto a frigid January?
Well, the real concern is what they're going to do about powering their factories right now. Come January, obviously, they're going to have to heat their homes, but rationing is the big concern that you hear about now, and finding alternative sources of energy, it doesn't seem like they're having much success there. They're falling back on the big coal reserves that they have, but they're not willing to turn around their plan to shut down nuclear completely by the end of the year.
It is an image from Jeddah. Anne-Marie Horton out with a pass that she had as she's on the White House charter with the president. I'm not sure if she's sitting next to the president or just a couple now with the president on a unimaginable trip looking over any number of conflicts and legitimate wars back at least to 1948. For me, it is a course about the shock of 1967 the shock and surprise of Carter and Sadat and the Sadat assassination, as we saw in Japan this week. Always a time for a nation and a region to stop. And now we see diplomacy. Matt Miller, what is so important here is a diplomacy of a president with the courage to go south to Jeddah.
Absolutely. That's what we're seeing here. I think it would be interesting, and a lot of people have said he may want to go to South Texas, really, and look at how he can boost oil production here rather than there. Although, as we can see, the truth of the matter is he's in Saudi Arabia and not in Oklahoma.
A truly historic moment here on the Red Sea. Our Anne-Marie Horton will be reporting through the day. I believe the temperature is 100 degrees in Jeddah as it's across 110 in the heat of the Kingdom of Saudi Arabia summer. Please stay with us on Wall Street Week tonight. Our guests, David Bianco, Lori Calvasina, Greg Fleming, and Professor Summers, also in attendance, Lisa Abramowitz. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
A market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City, for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
We begin with the big issue, a monumental 2 weeks for the Federal Reserve.
This inflation print, it's a problem.
The threat of inflation has to be taken really seriously.
We're likely to see another very hawkish Fed meeting.
You're seeing it in the rhetoric.
This news from Mr. Bostic.
This Fed isn't stopping.
For him to say put everything on the table, that does open us to 100 basis points.
Certainly 100 basis points will at least be a point of discussion for the Fed.
This is a very hot report.
The only way to fight that is to generate a recession.
Stickier inflation and therefore a stronger Fed reaction, raises recession risks.
The Fed is very keenly aware of that.
Fed officials have been saying they are very committed to getting inflation back down to 2%.
What Atlanta Fed President Bostic just said.
Right now, they are almost solely focused on the inflation mandate.
Highlighting the concern around hiking into weakness. Joining us now, Top Atkins, Michael Purvis, and Krishna Mamani of Lafayette College. Krishna, I want to start with you. How realistic is it that the Fed would go 100 basis points given some of the macro headwinds?
Well, so some of the governors had indicated that they were waiting for two pieces of data, retail sales, when we got that, and that's harder than expected. And then the U.S. survey data, and that should be coming out relatively soon. I think the likelihood of a 100 basis point increase based on retail sales, in my mind, is quite high at the moment.
Meanwhile, Michael, we are looking at the idea that possibly the Fed has underestimated inflation to such a degree, and we have continued to see that this week with the CPI print. What are you looking for in terms of what is the least likely to be a policy error from here?
I think we're living in an environment where policy errors are just going to be par for the course here. You're dealing with a Fed that seems to be increasingly sensitive to headline inflation, and the divergence between headline and core is at multi-decade highs right now. And if the Fed keeps sort of eyeing petroleum prices, food prices to some degree, it just means that they're swatting mosquitoes with a sledgehammer more and more, if you will, right? And so they can bring down inflation, but it's a crude tool to do that with, given the supply conditions that are particularly exacerbating the headline side. So look, I think, and I'm not. This is not a critique of the Fed. I just think it's how the chessboard is set up. They are in a very difficult place. And you're going to see policy errors for some time, and I think that's going to keep cross-asset volatilities very elevated until they stop doing that, right? And so I think that to me is that I think the range of side effects from this aggressive pivot from the Fed is just very high.
And meanwhile, we are seeing markets continue to climb ahead of the open, with the S&P up about 1%, despite some of the headwinds. Fed Governor Chris Waller yesterday saying the economic data will dictate the Fed's road ahead. Take a listen.
I fully support another 75 basis point increase. However, my base case for July depends on incoming data. We have important data releases on retail sales and housing and inflation expectations coming in before the next meeting. If that data come in materially stronger than expected, it would make me lean towards a larger hike at the July meeting.
Krishna, what's the takeaway from this week, given that we saw certainly Bank of America and others pivot to lower estimates for the S&P and a worse outcome for the U.S. economy?
Well, so I think having like a 4,000 type expectation for S&P in the current environment didn't make any sense. So they're basically scaling it back to what the reality is. Having said that, I think the outlook from a Fed's perspective, and Michael was talking about policy error, in that context, you have to define what the policy is. And they have actually articulated what their policy is, which is they're focused on headline inflation for the time being. And as long as headline inflation, which in Powell's judgment drives inflation expectations, remains inordinately high, they will be focused on slowing things down and slowing things down meaningfully. My expectation, however, is towards the end of the year, the Fed's posture would be a little bit more rational and a little bit more forward-looking than what they are dealing with at the moment, which is really high top-line growth. And I think eventually they will slow down. Eventually they will probably cut in 2023. So a bottom is in sight in terms of markets. It's not today, and it's probably not till the later in the year, the earliest, or more likely next year.
Meanwhile, we did just get retail sales and a slew of economic data trying to parse just that out. U.S. retail sales topped forecasts, showing signs of a resilient consumer. The data keeping another big rate hike on the table, with Fed officials getting their last licks in before going dark ahead of the July meeting. Mike McKee over in Idaho with more, joining us now. Mike, what's the big takeaway from the latest slew of data?
I think the question is unanswered yet about whether the data are going to push the Fed to 100. The retail sales number is kind of interesting. It comes in stronger than anticipated, but you look at the composition of it and you can see how much of that is gasoline and also in food. I just have gasoline on this chart here. But gas and food, gas was up 4% and food was up 1.2%. Most other categories, while half of them were up and half of them were down, the ones that were up were only up by a little bit, much less than the prior month. So inflation taking a toll, and the economy maybe, and retail sales maybe slowing down. So did they get a green light from that? Too early to tell. The CPI, PPI, and obviously the jobs report say, yeah, you can go ahead and do 100. And we're still waiting on industrial production and those inflation expectations numbers. I'm putting retail sales in the hold category because I don't think it was as strong as it appears on the top. And in terms of those inflation expectations, we want to look at not just the 1 year anticipated numbers, which is the two lines at the top, but the 3 to 5 year numbers. Those are both surveys from Michigan and the New York Fed that do consumer expectations. And as you can see, expectations are that prices are going to keep rising this year, but then drop back. So they kind of look anchored at the moment. And if they stay that way when we get the Michigan numbers today, it'll be harder to make a case that the Fed needs to do 100.
Mike McKee, thank you so much, and for your ongoing reporting, which we'll hear from throughout the day. And it's just the soup of information, not only from the economic data, but as well as bank earnings, which have continued to roll in. Citi was surprising with a profit beat, soaring past estimates. The firm outperforming its peers in early trading, holding on to about a 5% gain. For more, let's bring in Bloomberg's Sonali Basak. Sonali.
Yeah, Lisa, if you take a look at Citigroup's shares, shooting 5% higher today because fixed income trading beat expectations. To give you a sense of how much they beat expectations, a more than 30% jump in fixed income compares with about a 15% jump in that same business at JP Morgan, which missed expectations just yesterday. So Jane Fraser is doing something right, investing in traders and investing in investment bankers. Investment banking activity, however, is also being impacted by recessionary fears, which Mark Mason, the CFO of Citigroup, is speaking to media right now, talking about how those fears are impacting the future. Most importantly, in terms of share buybacks, Citigroup is joining JP Morgan in pausing share buybacks. Now, Jefferies had estimated this would probably happen given higher capital requirements, and that is certainly one of the reasons Citigroup is pausing. However, Mason also cites uncertainty in the macro environment ahead. I have to say, the big question mark then becomes Bank of America on Monday. Jefferies also estimated that they would also be subject to higher capital requirements. So are they going to follow the pack in pausing as well? You have Wells Fargo as well today reporting just a smidge lower on the day. Provisions for credit losses were a little bit higher than expected. So that macro uncertainty is going to continue to weigh on the banks. Remember, Wells is trading just below book value. You've got to wonder at this point if book value is the fair value.
Sonali Basak, great work as always. Thank you so much. Still with us, Michael Purvis and Krishna Mamani. Michael, how much is a head fake of idiosyncratic stories here with respect to stress tests, with respect to regulators pushing banks to suspend share buybacks for the time being, and how much is an indication of battening down the hatches, preparing for something that they see coming?
Look, I think, if you were running one of these large banks, you'd probably do everything you can to batten, just to, manage the street down on everything, right? There's good risk return for the CEO in doing that. If we don't get a recession next year, then he'll outperform. And if we do get a recession and some of those losses are low losses and so forth, and revenues are down, then he's prepared the street for that. So to me, one of these overarching questions when you're trying to think about earnings, corporate earnings for the second half of this year and in 2023, whether it's for JP Morgan, Citibank, or pretty much any other stock, is there's just a ton of speculative guesswork about, oh, we're supposed to get a recession. Oh, but the PMIs are at 55 and unemployment, keeps, the employment data keeps coming in pretty exceptionally strong, actually. So there's a lot of, I think, speculative guesswork about, this almost binary outcome of recessions, which is really going to sort of define earnings there.
Krishna, what's your view here? How much is the banking sector showing strength versus weakness ahead of a consumer slowdown that a lot of people are expecting?
Well, I think what the banks are showing is that if you look at current conditions, we are not in a recession, and their profitability because of volatility in the capital markets and because of their core lending business is still quite good. However, as Michael said, we are preparing, or the banks are preparing for what may look like in 2023 and making provisions. So I think the operating performance so far has been quite good. The biggest delta really has been in provisions, and I think the rally for Citigroup is driven more by the fact that it is the cheapest bank or cheapest large bank out there, and their operating performance was slightly better than expected. One key point here, I think Michael alluded to it, but I think it's worth repeating, that is credit losses in this cycle may be somewhat lower than what we have experienced in the past because the private sector balance sheet is in much better shape going into a recession if we get there.
That has been one saving grace, at least according to a number of people, have looked for a softer, shallower recession rather than the deep one that a lot of people are fearing. Michael Purvis, Krishna Mamani, both of you sticking with us. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Kaylee Lyons. Kaylee.
Well, Lisa, a few of them moving on the back of earnings, including United Healthcare, the insurer. It's up about 2.5% after a beat and raise quarter, really benefiting from the rise in enrollment it's seeing. Then, of course, you already ran through Citigroup. You have beats on revenue, FICC trading, net interest income also coming in above expectations. So even, yes, there's that news on that share buyback pause. The stock's still up nearly 5%. Separate to the earnings-related stories, one out there, Pinterest, a big move higher after a 50% loss this year. It's up 14% on a Wall Street Journal report overnight that Elliott Management, the activist investor, has taken a more than 9% stake in the company. To the downside, though, a lot of clean energy and solar stocks after Joe Manchin, the senator from West Virginia, said he is not going to approve of any new climate spending that President Biden would like to see through. So that stock is down more than 5% before the bell, Lisa.
Kaylee, thank you so much. Coming up, President Biden en route to Saudi Arabia.
The reason I'm going to Saudi Arabia, though, is much broader. I think we made a mistake of walking away from our influence in the Middle East.
This as domestic pressures build for the administration back home, particularly around inflation. That conversation coming up next. We're trying to end the week, it seems, with a bounce here with S&P futures indicated up about 1%, with about 17 minutes now to go to the open. From New York, this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The reason I'm going to Saudi Arabia, though, is much broader, is to promote U.S. interest. Promote U.S. interest in a way that I think we have an opportunity to reassert what I think we've made a mistake of walking away from, our influence in the Middle East.
President Biden heading to Saudi Arabia with political tensions simmering back in Washington, D.C. Senator Manchin blocking the administration's economic agenda, his spokesperson saying, quote, it's time for leaders to put political agendas aside, reevaluate and adjust to the economic realities the country faces to avoid taking steps that add fuel to the inflation fire. He was talking about not raising taxes and a host of other spending that he did not want to join in on. Joining us now is the Bloomberg team, Emily Wilkins down in D.C. and Anne-Marie Herdern from Jeddah in Saudi Arabia. And I want to start with you, Anne-Marie, because we have gotten some shots of the Middle East trip and of the plane taking off. What is the schedule for today? And give us a sense of the import of the various meetings that President Biden has.
So when President Biden lands in the kingdom, he's going to meet his counterpart, King Salman, and then he's going to have a working meeting with the Crown Prince Mohammed bin Salman. And this is really the pivotal moment of this entire Middle East tour, Lisa, because, of course, the president had vowed to make the kingdom a pariah. He has been very harsh on the Crown Prince, leaking that intelligence report, saying that intelligence report which said that the Crown Prince signed off on the killing of Washington Post columnist Jamal Khashoggi. And now he's going to have a working meeting with the Crown Prince, the individual who runs the day-to-day operations of the kingdom. And Lisa, when you're talking about what's happening here in Saudi Arabia, you mentioned what's going on back at home. I know Emily's going to talk about Senator Manchin. The common theme for what is going on and the hurdles this president is facing is inflation. Because here in the kingdom, he's going to look for any sort of oil the Saudis could add to the market. No announcement on this trip, we are told, but potentially in the future at an OPEC meeting, the Saudis will be the ones that could push their thumb in the market and help the administration a bit.
Meanwhile, Emily, Anne-Marie mentioned Joe Manchin, the senator from West Virginia that holds perhaps the most clout of any legislator down in Washington right now, basically coming out and said he cannot support even the pared back, Build Back Better plan of President Biden. How much does this set Biden back, and how much does this basically indict any potential legislative action by Congress given the midterm elections coming up?
I mean, this at this point seems like curtains closed for Biden getting any sort of major climate policy done at this point. This was going to be the vehicle for that. It was on the table until last night. Also, Democrats were looking at a number of tax hikes. They wanted to sort of tax wealthier Americans, tax corporations. That now also seems to be off the table. What's left would be lowering drug prices and extending some health care subsidies for millions of Americans. Still certainly something, but far, far less than Democrats wanted at this point. And it really speaks to the difficulty that Biden has navigating the Senate that's divided 50-50 and really allows any senator, in this case it is Manchin, to kind of have the power to just veto major building blocks. At the same point, you talk to other Democrats, even very progressive Democrats, who say that they want to get something. They realize the situation that they're in. They realize that putting additional pressure on Manchin is not going to work. And if we do see some sort of very, very, very slim down version of Build Back Better come to the Senate and to the House, it does seem at this point that there might be potential to actually get that passed. So again, far less than what Democrats wanted, but potentially a few items on health care.
Emily Wilkins, Anne-Marie Herdern, thank you to both of you. Still with us, Michael Purvis and Krishna Mamani. And while we were speaking, I do want to just bring you some headlines from the St. Louis Fed President Jim Bullard, who is speaking, talking about how the U.S. economy is quite strong. He doesn't see a recession out there. This is the positive. And here's the negative. He sees possibly the Fed hitting 3.75% or a 4% Fed funds rate by the end of this year, and then said that they could potentially do this in the front-loading kind of way or spread out. Either way, Krishna, how significant would it be, and how much is it not priced into markets of the Fed moving to 4% by the end of this year?
I think moving to 4% would be really a very significant move for sure. But given the breadth of inflationary pressures that we saw in the CPI, even the core CPI, it's to some extent the possibility of that has to be expected. Inflation is broadening, and the Fed has to do something, and do something quickly. So from my perspective, 3.5%, 4%, is it in the cards? Probably, given the slowdown that we are seeing, it's probably less likely, but is it possible? Entirely. The challenge really isn't for this year. The challenge is once they get to 4%, what are they going to do next year? And I think that's the data point that the equity markets would be looking for.
Michael, when you take a look further out, I want to tie in the policy discussion, the fact that right now Washington cannot pass something very easily, even something with bipartisan agreement like chip legislation. How much support will there be when the economy does seemingly inevitably turn over at some point and face some serious headwinds?
Look, I think gridlock, political gridlock in D.C. has sort of been in the markets for some time. You know, I mean, I think most people would agree that the House has a good chance of moving to Republican control. He hasn't, look, with the House and Democratic control, he hasn't been able to get much done at all. That doesn't look like it's going to change at all. So if we get a mild recession, is there going to be a strong and compelling argument to make for something, sort of some sort of incremental fiscal response? It sounds unlikely there, but I don't think that necessarily is going to be bothering the equity markets or the rates markets too much. I think to a certain degree, I think fiscal gridlock will be, traditionally it has been a sort of a market-friendly outcome, and that may actually be sort of reinforce more favorable market conditions there. If we get a severe recession, then of course that's a different situation, and that will be interesting as well, particularly given the fiscal response from COVID creating inflation.
Just real quick here, I'm wondering from your perspective, as you look out past the disruption, you said that the big issue is going to be next year and the year beyond. How do you arrange a longer-term portfolio amid short-term extreme disruption?
Well, so that's really an interesting topic. I think for long-term investors like endowments and pensions, you basically have no choice but to see through this, because at the end of the day, the judgment that you're making is what would be the state of the U.S. economy for the next 5, 10, 20 years. And I think on that front, based on any level of historical analysis, we will get through this. The private sector balance sheet is meaningfully better than it was in 2008. And unlike 2020, when we didn't know whether we would be shut down for a half a year on a global basis, we are in a much better position. So I think things are looking quite uncertain at the moment, but we will get through it. And I think 2023, if the Fed can slay the inflation dragon, 2023 and beyond may actually be quite good.
Krishna Mamani, Michael Purvis, both of you, thank you so much for your time and have a wonderful weekend. Coming up, the morning calls and later iCapital's Anastasia Amoroso seeing the Fed's inflation battle, keeping stock returns muted. She's not alone in that conversation. Coming up next as we try to eke out some gains here heading into the open. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA. surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Taking a look at the markets, climbing into the open, 1.2% gain for the S&P. The Nasdaq hanging in there too with a 1.1% gain, and you are seeing stability after a week of tumult. Time now for our morning calls. A look at some of the analyst recommendations this morning on Wall Street. First up, Barclays downgrading Rackspace to underweight with a street low $5 price target, expecting macro volatility to weigh on customer spending. Next up, Argus downgrading Delta Airlines to hold, pointing to rising costs and staffing shortages. Finally, Edward Jones upgrading Qualcomm to a buy with chips still in demand. The Open coming up next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Trying to claw back back, some losses from the week. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading with a solid almost 3% gain for the S&P heading into the Open. The Nasdaq up about 1%. You're seeing pretty much stasis in a lot of the other markets, a bit of calm after the disruption really happened in currencies, dollar strength. Now we're seeing a bit of dollar weakness, giving a little bit of support, perhaps, to a feeling that things are not going to experience a fissure, flatlining on the 10-year, 2.97%, and crude even up a little bit. So after a week of discussion about recession and gloom and doom, a bit of stability here. Joining us now with a look at stocks moving at the opening bell, here's Kaylee Lyons. Kaylee.
Well, Lisa, one of the big ones to the upside is Citigroup, up more than 6.5% at the open after beats really across the board, even if they are pausing share buybacks for now due to higher capital requirements. For Wells Fargo, also in positive territory, up 1.7%, even though it was a less positive story with credit provisions, a bit of a concern there. PNC beat on the top, bottom line, but not on the top. It's down 1.5%. And BlackRock, an interesting story, assets under management falling to the lowest in almost 2 years. You're seeing bit of a missed expectations when it comes to inflows. Nonetheless, that stock still up 1.4%, probably taking part of this broader rally. And also rallying today is a lot of the retail names after we got that stronger than expected retail sales data this morning, up 1% higher in 19 of 13 categories. The control group largest gain since January. So a big lift for Macy's, up nearly 3%. You have Walmart and Target higher as well. And Amazon coming off of a pretty successful Prime Day, it seems, up about 2% at the opening bell, Lisa.
Kaylee, thank you so much. I do also just want to give you the updates as Jim Bullard of the St. Louis Fed does continue to speak. He says that over the next 18 months, inflation could go back to 2%. This after he was talking about the possibility of even a 4% Fed funds rate by the end of this year. Interesting to see what pain it will be required to get that. So far, the pain is not being felt, and we have seen that in the big bank earnings as they roll in. Shares of Citi spiking at the open. Quarterly profits soared past analyst estimates, with CEO Jane Fraser writing in a statement, quote, "In a challenging macro and geopolitical environment, our team delivered solid results, and we are in a strong position to weather uncertain times given our liquidity, credit quality, and reserve level." Sonali Basak has been listening to the call, covering all of the banks, including Citi. And is there a broader takeaway here, or is this a very specific turnaround story, Sonali?
This is a very specific turnaround story because you have Citigroup that was trading less than half of their book value, just a heroic sell-off in Citigroup shares as Jane Fraser looked to turn around the bank. Now you have them exiting many of the operations in a single year that they said they would. They have reduced their exposure to Russia in terms of possible losses or in hits to capital that they could take. And it's sinking in among investors that, yes, it's scary to see the big banks announce that they're pausing share buybacks from JP Morgan and Citigroup. However, perhaps it's better that they're being safer into a tougher economic environment. You have a CFO, Mark Mason of Citigroup, talking to the media just right now, just sending the call. And what he's saying is that more than a recession, where he sees a probability very likely, a high probability by the end of next year, he's saying that he's more concerned by the macroeconomic issues you see now, such as inflation. And so for a bank like Citigroup to navigate better than Wall Street expected in some core businesses, it's like we were saying earlier, Lisa, all good news is very welcome in a tough environment.
Sonali Basak, thank you so much. Tech, meanwhile, has been a different story, a very volatile week, with investors starting to gear up for a big 2 weeks filled with earnings in this space. Bloomberg's Ed Ludlow joining us now. Ed.
Yeah, good morning, Lisa. Happy Friday to you. We're pushing up higher in the NASDAQ 100, up almost 1.5%. You heard Kaylee talking about Amazon, one of the biggest points movers to the upside, along with mega caps like Apple and Microsoft. Everything that we're considering in my world, though, is everything you're considering in your world. The aforementioned consideration around how large the next rate hike will be from the Fed, the inflation problem, and the prospects of recession. But we are keeping an eye on the next few weeks of earnings. For me, this is a critical earnings period, right? Because you get the lens of the strength of the global consumer, as well as how the supply chain is holding up. All of these things seem somewhat ancillary to what's going on with rates, but we're still focused in. Two news stories I'm keeping my eye on. The first in the semiconductor space. SK Hynix, according to sources telling Bloomberg, that they're going to cut capital spending by as much as 25% through to next year. Really significant because they're one of the biggest maker of memory chips. The lens that we're going through is that they're seeing slower consumer demand for electronics, less need for memory chips. They go through the glut. The other one is Pinterest, of course. Wall Street Journal out with a report that Pinterest is in talks with Elliott Management, who have acquired a 9% stake, according to their sources. You can see that stock up almost 16%. at the open. Really interesting move, although we don't know what it is that they're talking about. It's a name that I discuss less in my world. It's been a volatile week, as you say. We've gone from thinking about 100 basis points hike to kind of thinking again, right? We closed 0.3% higher on Thursday. We're up significantly Friday. We're getting sanguine. The vibe is good. I'm happy, you're happy, and we're pulling back our expectations for a hike. That's why we're zeroed in on earnings, because put the hike aside, I want to know what's going on in the world.
Ed, thank you so much. And not just are we perhaps tempering some of our rate hiking expectations, but Societe Generale and analysts there are now saying that they see the first Fed cuts in early 2024. And so they keep their terminal outlook around 3.4%, even as Jim Bullard says he could see 4% at the end of this year. This all dovetails into tech, as Ed was just talking about, with investors really focusing on that. Dan Ives of Wedbush writing, quote, well, this week, banks ripped off the Band-Aid on earnings. The street is now laser focused on earnings from the tech sector around the corner to better gauge the health of consumer enterprise in a softening macroeconomic environment. Bloomberg's Taylor Riggs joining us now with more. Taylor.
And Lisa, really starting Tuesday after the bell of Netflix, Wednesday when we're thinking about Tesla, Thursday on Snap, Friday maybe Twitter. So you're right, and really focusing on technology, of course, next week. I think what's so interesting is we're actually going to have to wait until the week after that, closer to the 25th, to really get, in terms of market cap, the biggest sort of quarterly results when we think about who really is performing and showing up. So that'll sort of be a bigger week. But next week, we're going to start to get a little bit, about 19 or 16% or so here when you think about the actual market cap. So far, though, and we only have about 31 quarterly results out, but you're getting a little bit of an upside surprise, 0.8% relative to estimates, better improvement on the bottom line when you think about where we are relative to estimates, and a one-day move that shows the stock reaction a little bit better than muted, but certainly not really crushing it when we're coming out of the gate here. The average one-day move for those stocks are about 0.3%. When we think about, though, folding this in, Lisa, to the stock story, to the fundamentals, we've talked a lot about some of these big tech companies warning of either slowing hiring or stopping hiring, or maybe some layoffs as well. And that's been the big story. When you have these big growth companies, that the big pivot has not been growth at any cost. You're really looking at some of the reasonable growth and how we think about the bottom line. Some layoffs is also going to be a story that we're really watching for.
Taylor Riggs, thank you so much. iCapital's Anastasia Amoroso laying out her bottom line for stocks, writing, quote, we may still head lower on the S&P, and in an environment where cash now pays you something, economic growth is slowing, and the Fed is not your friend. The relative value of stocks is diminished. So pleased to say that Anastasia Amoroso is now with us here in her office. And I'm wondering, Anastasia, how much do you see the earnings season, at least how it's set up so far with those that have trickled out, being either an upside surprise or a downside surprise for some of those estimates for the S&P out there on Wall Street?
Yeah, Lisa, good to see you. And I think the early results really suggest that the earnings season is nothing to write home about. If you look at the surprise that's coming out right now, it's maybe 1 or 2%, which is well below what we've seen in the last number of quarters and well below kind of the 3 or 4 or 5% average. So I think the expectations probably reset somewhat. They may still need to reset lower. And of course, what's really capping the upside on stocks here is the fact that $240 on the S&P 500 next 12-month earnings estimates, that's likely going to need to come down. Because the reality in front of us today is to slow inflation, which is so stubbornly high, the Fed needs to slow demand. And the more inflation stays elevated, the more the Fed needs to slow down that demand. So that's kind of the negative, development that's playing out here. So earnings estimates are capped, and they're likely going to be pressured down by the Fed.
How much, when you talk about not fighting the Fed and the Fed is fighting inflation, how much cohesion do you see among Fed officials? And I'm wondering this as Jim Bullard comes out and says that he favors a 3.75% to 4% range for Fed funds rates by the end of this year. And he talks about how the U.S. is in a great place and that actually there's plenty of momentum, doesn't see that recession, which is probably bad news for some because it means that the Fed could be more aggressive. How much does he represent the mainstream that investors should not be fighting on the Federal Reserve?
Yeah, I mean, luck for all of us. There's so much uncertainty around the economy, and the Fed looks at this index of economic uncertainty, which is at really the most elevated level. So I do suspect there's quite a bit of discussion going on, but at the same time, the more and more we get these highly elevated inflation prints, I think the more and more there must be a realization within the Fed that it's not only not certainly transitory, but now this is sticky inflation. What I worry about, Lisa, now is that it's not about the headline inflation that's really took the markets by surprise this week, but it's about the core. We have all been expecting that the core is going to start to come down, and it's coming down somewhat on a year-over-year basis. But if you look at the sticky components, like shelter, for example, like wages, they're not moving lower. In fact, on a month-over-month basis, they're moving higher. So I think the more the Fed sees these sorts of moves within the core inflation, the more there's likely to be some cohesion around the fact that this is becoming sticky. This is a problem that we need to address more convincingly. So that's why, the markets have pulled back the expectations for 75 basis points or for 100 basis points and just in the last couple of days for July. But I think 100 should probably be on the table because there's no FOMC meeting in August. Inflation surprise to the upside, so I think the Fed can surprise to the upside as well.
And meanwhile, we haven't seen as many surprises to the upside, perhaps, as some people would like in the earnings that we've gotten so far. RBC's Amy Wu-Silverman gearing up for volatility on the heels of all of this. Take a listen.
We've been waiting for what will kickstart equity volatility, and we've seen, the red flags in the rates market. The fuel to the fire will continue to be other earnings that are just coming on board right now. We're only at the beginning of what, I think it's going to be a tumultuous earnings season.
And I think a lot of people would agree with Bank of America coming out and saying that they think that there will be a true correction, a true capitulation as we get some of these earnings and see some of the forward forecasts. A lot of this has to do with the dollar, the strong dollar, and the multinationals that are facing the consequences of that. How much have we priced in a dollar that has remained incredibly ascendant and only accelerated that trend this week?
Yeah, I think, Lisa, we've priced in a fair bit of it, right? I mean, the markets have been repricing the rate momentum for a while. We have been repricing the dollar momentum for a while, and the valuations went from 22 times to 15.5, 16 times on forward earnings. So I think we did price in a fair bit of that already. But as far as this earnings season goes, I want to go back to the banks for a second, by the way. I don't think it's quite as gloomy, and maybe it doesn't have to be quite as gloomy as the initial read of this has been. And for the banks specifically, I mean, that's kind of a pretty good read on the economy that tells you that it's still hanging in there. The fact that loan balances are moving higher is actually a positive read on the U.S. economy. The fact that the net interest margins for the banks are actually expanding, that's a positive development for the banks. The fact that they have levers to pull to rebuild some of the capital buffers. So I do think that despite the volatility that's expected around this earnings season, I think what companies are going to focus on right now is, for now, the economy is still in okay shape, and for now, we're still managing okay.
Which is a different, perhaps, read-through than some are expecting, not only with big banks, not only with retailers, but also big tech, which report earnings over the next 2 weeks. Neuberger Berman's Jason Tauber seeing tough times ahead for that sector, writing, larger tech companies are not immune to the widespread economic challenges and will be rewarded for protecting the bottom line. In this risk-off environment, investors are prizing current profits over growth. We have certainly seen that, and the likes of Microsoft, as well as Facebook or Meta, whatever you want to call it, have talked about paring back some of their hiring trends. Do you think that we will see, Anastasia, the same strength that you're talking about, the same optimism in some of the underlying aspects of banks in the tech sector?
I don't think tech is immune from a slowdown, and I think there's parts of tech in particular that are going to be hit harder than others, and I worry about the semiconductors, for example. That is a sector that is highly correlated with global GDP growth, and that GDP growth is clearly under pressure. It is coming down. So I think despite the secular opportunities that, of course, we see in semiconductors, I think from a cyclical standpoint, they're going to come under pressure as consumers rein it in, as the corporations rein it in. So a little bit cautious in the semiconductor space. I mean, I like software, but I do think we're probably going to see some softness in software as well, because the big theme for me, Lisa, for the second half of the year, it's about prudence. That means consumers being prudent with their spending, but it also means corporations being prudent with their spending. And yes, of course, they're still going to invest in digital transformation and artificial intelligence and all those enterprise spending initiatives, but probably a little bit less so than they have been doing in the first half of the year or last year. So I suspect the guidance is not going to be quite as positive as we might have been accustomed to for software. Having said that, the valuations have reset a lot. There are profitable software companies whose margins are double that of the S&P 500. So it's still a space I want to be in, especially now after we've seen this massive reset.
Well, we'll have more. Anastasia Amoroso, you're sticking with us, and coming up, we'll focus a little bit more on the European markets, which have been on edge amid mounting political uncertainty.
Such a strong majority with such a strong leadership is the best solution to implement all our plans.
That conversation coming up next. We are seeing the rally stick in the initial 15 minutes of trading with a 1% gain in the S&P and NASDAQ, more or less, retracing some of the losses and tumult of the week. From New York, this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Such a strong majority with such a strong leadership is the best solution to implement all our plan, and especially our recovery and resilience plan.
Political turmoil in Italy looming, with Prime Minister Draghi's government in limbo. The pressure on the ECB to agree on a framework for its new tool mounting. Bloomberg's Guy Johnson joining us now for more. Guy, how politically difficult does it become for the European Central Bank to essentially back Italy's bond market by buying bonds at a time of complete political uncertainty with a real uproar in the government?
Somebody put it to me yesterday, Lisa, technically they shouldn't. In reality, they probably will support Italy. The transmission mechanism has always been key to the ECB. They want to make sure that policy changes reach all four corners of the Eurozone, as a result of which Italy and its problems may still fall within the purview of this new tool that we are going to get. It is likely to come with limited conditionality, and that is going to make it a little different from the OMT, so may make it acceptable to the ECB. But there's some irony that this all centres around, of course, Mario Draghi, the man that said he would do whatever it takes, Lisa, to protect the euro. Now he is front and centre in certainly undermining it.
That is a clever irony to point out, Guy. Thank you so much for that. iCapital's Anastasia Amoroso back with us, and Guy was really highlighting the conundrum that sent the euro below parity versus the dollar yesterday solidly, rather than just simply a blip on Wednesday, as we saw. How much do you view recession as an inevitability that's been fully baked into the euro region, and the companies in the U.S. that are most exposed also pricing that in?
Yeah, I think it is becoming somewhat inevitable in the Eurozone, and I think it's in stark contrast with our outlook for the U.S., which is much more resilient. But between the energy exposures of the euro area and between the potential for higher rates to really meaningfully slow the European economy, this is vastly different than it is in the U.S. And what I mean by that, there's an area of the European markets that I worry about a lot, which is the residential real estate. And not only has the ECB flagged that the prices of residential real estate have really screamed higher to the levels where they may now be overpriced and due for a correction, but as the ECB is forced to raise interest rates because of the inflation that it's trying to combat, the places like Italy, like Portugal, like places like Estonia, where a lot of the residential mortgage is a floating rate, they might actually experience a materially higher cost of capital that impacts the monthly bills. So this is why I do worry more about the adverse impacts of higher rates and higher energy prices on the Eurozone. So I think we've priced this in, to your point. That's why euro is a parity, but I don't think it breaks away from that anytime soon. I mean, if you think about the growth differentials, if you think about the interest rate differentials, we're talking about almost 3.7% on U.S. Fed funds rate by the end of the year. Yeah. We're looking at maybe 1.15 for the euro in the next 12 months or so. So that's quite a gap. That's still going to favor the U.S. dollar.
This is incredibly important, Anastasia, especially because next week we find out whether Nord Stream 1 comes back online and the gas input from Russia is what it was pre-maintenance. How much does the euro rally actually versus the dollar if it does come on and Russia does continue sending gas to Germany and the rest of Europe versus the downside if they do not?
Well, I think it would be a relief for the euro, but I would suspect it is a temporary relief, because I think the biggest thing that's really dictating the value of the euro is, once again, is the interest rate differentials and that's the growth differentials. And, you know, if the gas does come back on, I think that's a short-term relief. But the reality is oil is still around $100 a barrel, and I don't think that's going to change anytime soon. So that's still going to squeeze the economy.
Anastasia Amoroso, thank you so much for being with us. Have a great weekend. Coming up, the market-moving events that you need to be watching. That's next in our trading diary at a time when we are trying to claw back some of the losses from a week where recession was the main theme. From New York, this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Countdown to the Open, ending the week with a breath of relief with a gain for the S&P up 0.7%, 0.5% for the NASDAQ. What you can see in bond markets is stasis. You are not seeing a huge rally. You are seeing a bit of a sell-off, although that's actually gone into a rally as people parse through the data. The 10-year yield now down to 2.95%. The 2-year yield up as people talk about the potential for perhaps more aggressive rate hikes, which is why the yield curve has been the most inverted going back to 2000, the year 2000, and that is leading to a lot of concerns about what we might see in the economic outlook ahead. Time now for the Trading Tire, what you need to be watching in the week ahead. The University of Michigan Consumer Sentiment Survey coming at the top of the hour, plus Fed speak from Mary Daly and President Biden landing in Saudi Arabia later in the day. Next week, Bank of America and Goldman Sachs both reporting results on Monday. Netflix earnings coming out on Tuesday. Rate decisions from the Bank of Japan, and key to watch, the European Central Bank on Thursday as they face off between a rock and a hard place, trying to raise rates into slowing growth and an increasing likelihood of recession. This was Countdown to the Open. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Pepsi's Number Fever campaign in the Philippines
has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down